All right, everybody, welcome back to the Cashflow Chronicles. We got a special guest, TJ the Wheel Deal, coming at you live, as he would say, from Texas. I am back in a hotel room in Pennsylvania visiting family. That's why I'm a little bit tardy, so I apologize. And of course, we have, as always, Hot Chris the They See God, as much as he loves me calling him that.
Stop calling me that, dude.
No, man, I gotta keep going. I will stop. You've mentioned it multiple times. If once you say it multiple times, you gotta respect people's wishes. But a lot to talk about today. I'm just glad that TJ's back home. It's cool to see. So I caught him on a live earlier and just wanted to get him on here. And I know that I'd sent something to Steven,
I just
but
want to say one thing. Your hospital's gift shop sucks, by the way. They don't pick up their calls ever. I tried calling like 3 times. I was like trying to get this guy something for his bed, on this bedside to make him feel better. Guys wouldn't fucking pick up a call. There's no like online website either. So I was like, all right, whatever. I'm sure he'll be
you just
fine.
needed to call Boss Lady. She would have. I'm sure she
I
would have gave
know.
him a gift.
I messaged her. I messaged her on WhatsApp, actually. Yeah.
Cool. Well, glad that everybody's here. We have a lot of different things that we could talk about. We talk about NVIDIA. I know Chris and I discussed something. He messaged me earlier this morning, or maybe it was late last night. I was about to go. I was going to bed. It was like midnight my time, so it was like 1:30 Chris's time, and I hear ding, 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 and I'm like, "There's an emergency, or somebody's popping off." And so I look, and it's Chris with a couple messages talking about something that we should do on the pod. So I know Chris. Eventually, we're going to talk about that probably today. We could talk a little bit about it because I know we've talked about it in passing in the past, but this might be something that we actually go ahead and execute. And then TJ, you mentioned a little bit about how to just value stocks and kind of walk through that. And there's no one size fits all. So it's like
Right.
the arbitrary nature of valuing stocks, right? But there's that, and then Nvidia hasn't run out of the juice. And I don't know what you've kind of gone through with respect to what you talked about on Finance Junkies, Hot Chris, but I'll let you chime in.
Well, my thing on Finance Junkies was a lot of people are looking at Nvidia's growth and they're just like super happy, especially if you look at it on a year over year basis. For me, I am a little bit more hesitant on buying at this company at something that I consider to be at the top, but I could be wrong. Just I think the risk to reward is actually skewed negatively because semiconductors are typically very cyclical, where there's cycles where there's a ton of demand and then the demand falls off and then it goes back to having demand again in the future. The question is, Nvidia went from riding high on the crypto market and then dropping down significantly once the crypto hype died down, and then it rode back up the AI hype. And a lot of people are just saying, oh, well, AI is going to be here forever. Everyone's going to always need GPUs to train their models. And I'm just like, well, there's like a couple of factors that I'm seeing. Number one, you're moving from training to inference. So that's like number one. And NVIDIA is not as big in the inference side as far as I can tell. And then at the same time, you have the Microsofts, the Google, the Amazons, even the Metas of the world doing their own AI chip research, so that this way they can cut NVIDIA out of the mix, or at least utilize them a lot less. Because right now, those supplies of GPUs are what is powering these businesses, their cloud growth. So the last thing that these businesses want to do is be 100% vulnerable to NVIDIA, saying, look, if NVIDIA cuts us off, boom, that's it. We'll lose the AI race. So we need to have our own backup stuff. Granted that they may be like 2 years behind in terms of research, but that doesn't mean that they can't eventually catch up to a certain degree. And that means that maybe NVIDIA's lofty expectations in the future may not necessarily be there. So I don't know if there's really that much alpha left in NVIDIA, but this is, trust me, I am not the technology guy. Take my words as, as little as possible. Do your own research, do your own due diligence, and then go from there.
Yeah. Sorry, I was just typing something on X. I agree. I think Nvidia's had a very long trajectory, right? And when you think about it, a $500 price tag for the stock is $1.2 trillion, right? And so I think we're at a point here just to take a little bit of a breather. I think some people might have been thinking, hey, is this going to go to 525? Is this going to jump another 10, 15% like it did last quarter? And I think when you get to this sort of growth that Nvidia's kind of had and it's been priced in so much already, I think it needs a little bit of time to kind of follow through, a couple quarters to follow through before it maybe takes on another step. It could head to the 1.7, $1.8 trillion realm, but I think you need a couple quarters now where the hype has kind of been built into the stock for it to truly kind of follow through. And I think maybe people are a little bit scared to have it pop, let's say another 10, 15%, just based off the fact that it's already been kind of proven up in terms of a valuation so high already. So I'm kind of curious to see, where the stock kind of heads from here. I know it's back down to like the 480 something range or 490 range. Let me put on my little ticker thing. It was in the 489 realm. So I'm not sure when I typed this up about half hour ago if it's done a little bit of a reversal. Now that it's 10 at night, it's probably back down to off market hours. So probably now it's back into the 490s and overnight trading. So who's to know? Who's to know? I just thought it was pretty interesting as always. I think they did a really good job. I just even beating by the amount that they did for Wall Street expectations didn't hype up the stock. And I think maybe it was part of the Chinese, um, the I guess lower forecast for the Chinese market that maybe spooked everybody a little bit. At least that's what I was reading. I didn't actually listen to the earnings call, but yeah. TJ, you're not
So,
an Nvidia guy, are you?
there's a couple of stocks that I stock. That's like a little segment on my Power Hour. It's like my stalker stock, if you will. And Nvidia is definitely one of them. But I couldn't bring myself to buy it at 300, 400. I'm certainly not going to buy it at five. And it just comes down to valuations matter to me. And when I don't understand a valuation, I tend to just stay away. And it's like the reason I'm having such a hard time averaging up even on Palantir, because as excited as I am about Palantir, I've spent a lot of hours getting to learn a little bit about the company, watching a Myths channel and you guys on Palantir Weekly, and even the resident bear over here with Chris talking about Palantir. You actually learn a lot listening to people on the other side of the fence, quite frankly. So I think people need to pay more credence to people who are on your team, because you'll learn a lot more because they're being more objective about it, if you will. But the valuation just doesn't make any sense. But that being said, I was watching Finance Junkies a little bit today, and then Vitaly was going over their PE, and he's like, dude, it might not actually be overvalued if you look at that little metric right here in comparison to, say, Palantir's PE. So I don't know, man. It's one of those stocks that I'm just pissed off. I didn't make any money off it. I've never even played an option or anything. And I hate for things to go up so much, and I'm just not a part of it. But at the same time, there's 10,000 other stocks that I've never been a part of either. This one just happens to be one that I'm aware of.
Well, shout out to Dom, who comes on, on Palantir Weekly pretty frequently. I know he's a pretty big advocate for the stock, and he's had a pretty significant portion of his portfolio into it. So congratulations to him. He's really the only one that I know has had like an outright position, and I have a little bit of exposure through the S&P, but not enough where I could be like, yeah, like all about it, right? Because it's diluted once you get to that point. So.
What about you, Chris? You've never sold any options or your debit spreads or anything on NVIDIA? You've never seen the opportunity?
No, the value of the spreads was just always too high for me. Like, I like finding things that are undervalued relative to where the market is currently. Look at the macro factors that may be driving this company down, or not doing well, and just say, okay, can the management do something that's different that brings it back to life? Or can the macro change and make the thesis worth it? And then go on the option side and say, okay, from this option standpoint, does this company make sense? Because sometimes what happens is the option sometimes could be just too expensive. So the
Right.
risk to reward is always the thing that really drives my investing, whether it be on the upside or the downside of things. So for me, I think my goal is never, it's evolved from when I was younger to finding the 5X's and the 10X's. but now it's more methodical where it's like try to find the double, use certain leveraging tools to get you a lot more reward and cut down on risk. And then at the same time also avoid landmines, right? Like landmines are like the worst thing in the world, dude. So I think I've become much better at dodging the landmines today than I was ever in the past. So what I mean by dodging landmines is finding companies that look promising at face value, but then when you really dig into their business, their numbers, and just what part of the hype cycle they may be a part of, or what part of the macro cycle they may be a part of, and just basing it on that and just saying, you know what, maybe this is not exactly the greatest company on the planet. Like all the numbers are trending in the right direction, but why are they trending? And can they trend like that forever? So the key to Nvidia right now is the valuation is all dependent on this exceptional growth lasting for near half a decade. And I'm not sure that's necessarily going to be the case, but that's my thesis. I could be completely wrong, and I have been wrong on Nvidia because I thought they were grossly overvalued at $300, $400. The one thing I'll say is I had no idea how much demand was going to come for these AI chips. Even in my wildest dreams, I couldn't think that this was going to happen. But this is what happens. So the part that always gets me is when insiders in the industry don't pick these things up. Like if you're an AI and ML researcher, bro, you should have been buying Nvidia hand over fist, because you just know, like, hey, wait a second, like we're all fighting each other for GPU resources. Like right now, if you go to any company that's doing AI work, they're all just fighting each other for loads to do their training on, their model training on. So it just goes to show that the product is a key component to this new industry. But the question is, how much steam does this industry have going forward? Because eventually, and this is what tends to happen. You have these industries where the first discovery is made, and then people just get so excited they ride the thing to like the moon, and then eventually people realize, like, wait a second, this is not as easy to monetize as I was thinking, and then it traces back down a lot, and that's where the real buying opportunities are. Because then what happens is you have a nice long tail of growth ahead of it, but you have to be willing to basically look past the giant drop. And maybe one day Nvidia will have a $500 to $100 drop, and that's the time that you want to be buying it, but not right now.
Yeah, I'm kind of curious. I mean, they generate so much cash, and I don't really know. I need to look more into their cash flow statement to see. I mean, how much cash and on hand they're building, and if they're building at like an absurd rate, it could get back to the point where, I mean, the dividend yield is low. The dividend yield isn't low is low because not because they don't want to pay a dividend, but because the stock has been growing so fast, it's hard for it to keep up, right? And I think they do a pretty prudent job of raising it. But I'm just kind of curious from like a potential buyback perspective, are they going to end up in the route of like a Google or something like that, where they start buying back a decent amount of shares? And it makes me kind of think in the long term, is this something that could end up buying back a decent amount of the float just because they generate so much cash. I mean, their net margins are pretty good, if I remember correctly, and only getting better, specifically when you look at the most recent quarters because of the upselling that they're able to do from a AI perspective. And so, just kind of curious how that kind of goes. But I feel like I had something else I wanted to point out as well, but
let's
I
take
forget.
let's take a look at their numbers, right? So one of the things about companies is concentration risk is always something that I'm not a fan of. So right now most of their growth is coming from concentration. Their gaming has gone down pretty substantially over the last year and a half, 2 years. So you can see here they're down on their professional visualization. Auto, they're actually a little bit up on auto. OEM is pretty much down. So literally data center is what's driving their growth, but that also means that this could be a giant point of vulnerability, right? So if let's say Google, Amazon, Microsoft, Meta, all these guys, they stop making the orders because they see that, hey, maybe we got a little too ahead of ourselves with this AI thing, and you see a drop in revenue, dude, the valuation on this company could reset really hard. And so I would say don't look at Nvidia, look at Google, look at Microsoft, look at Amazon. watch them, because if they start cutting back on capex and they start saying, hey, we are not going to expand our data centers, we're not going to be hiring more ML scientists, we're going to be utilizing the resources that we have more efficiently, that is your key that in the future revenues for Nvidia are going to collapse, in which case, because of the high valuation, you'll see Nvidia's stock price collapse with it. So
How do their gross margins compare to like Google? Because I have that alpha spread. I think you subscribe to it as well, Chris.
mhm.
Alpha spread's kind of like my go-to move to get a lot of the metrics in one spot in front of me. And I want to say that when I looked at Nvidia, their gross margins were something like 60%. Net margins were like 18%. I mean, that's extremely strong.
Yeah.
I mean,
Well, I
they're
mean,
this is a money printer. Didn't they just beat earnings by like $2 billion?
yeah, no. So I totally agree with you. Right now, their gross margins is like 74%, right? Which is software level margins. Software makes that kind of margin,
Yeah.
not hardware. But Nvidia has figured out how they're going to really monetize the crap out of this. But once again, this is an avenue of weakness, not an avenue of strength, because what we're seeing right now is this is costing the big guys a lot of money. There's an incentive to get out of the ecosystem where you're paying for a product that has 75% gross margins. If you were able to just develop this internally yourself at your system, like the Google of the world or the Microsoft or the Amazons of the world, and they have the capital to do the research. That's the key, right? If you have the capital to do the research and get to maybe 80% of the capabilities what these GPUs can do, that's fine. As long as you're not paying a crap ton of money to Nvidia for their super high-end GPUs that give you, 100%. So my thesis on Nvidia is that eventually these giant cloud providers who are the major consumers of these chips, they are going to eventually back off. And when they do back off, you'll see a valuation reset. Because I mean, prior to this, their gross margin was like, I think 53%. So not only have they grown their top line significantly, they've grown their bottom line significantly. Last quarter, they generated 9.2 billion in net income. Now, remember, this net income is on the backs of the major players, right?
Right.
Just 2 seconds there, just it goes to show that Amazon is looking at this, Microsoft's looking at this, Google's looking at this, Meta's looking at this. Everyone is looking at this and saying, wait, I need to get in on this. Why the hell are we out of this business? Right? We want to grow at that rate. We want to generate those kinds of returns. If you are a customer and you're paying all this money, your first incentive is I need to figure out a way not to pay them that much in margin and to retain that margin myself. This way I can grow my own business. So that's my thesis on it. I think this is something that's commoditized, heavily commoditized, and you don't need it to be 100% to get to the point where people start switching away. You can get to 80%, which is fine, and then just say, okay, you know what? I don't need Nvidia as many Nvidia GPUs. They'll still get Nvidia GPUs, just not as many. So
So I'm curious. I mean, so I was just looking. I thought Nvidia was in the background raising the dividend, and I was just looking at a few websites, and they've been keeping it at 4 cents. And I'm just sitting here wondering why they're not raising the dividend as much. I mean, I understand that they want to reinvest and they want to be the innovator and the front leader, but they're starting to get to a point where they're able to build a lot of cash. I mean, they're sitting on $16 billion worth of cash. I bet that they don't have much debt. So I'm just kind of curious. They're keeping their share count flat just based off what I looked at. I'm just kind of curious why they're not starting to contribute even just a little bit towards dividends. And I'm not saying that they need to be focused and be like a huge dividend contributor. They don't need to be an Altria group, or they don't need to be an Intel or Verizon here. But to be generating so much and throwing off so much cash, maybe it goes back to what you're saying, Chris. Maybe starting to go down that path of paying too much in dividends, they might put themselves in a hole if the pendulum swings and you have people like Tesla and a few other companies that truly make their own chips, and then their net income starts to shrink. And not only will their net income shrink, their net margins will likely shrink as competition grows as well. So I'm curious if that's what their reasoning for not paying a dividend is, or if they're just so much in the innovation piece to say, hey, we need as much capital as we can to innovate as quickly as we are. So why pay a dividend? That's not where people are getting their growth or their money from. They're getting it based off of the return on capital that we provide, which is expanding like gangbusters. So maybe they straight up just said, we're not a dividend sort of company. We're trying to grow as fast as possible. That's how people are going to be making their money.
But I thought paying a dividend was almost like a last resort for some companies. They're like, hey, we run out of shit to do with this money.
Mm-hmm.
Let's give it back to you, because they're supposed to be trying to grow so they can command that kind of multiple. And it's almost like they're putting their arms up and being like, hey, our growth is about to start floundering. Here's some money so you can stick with us for the long term, because now there might be a valuation metric that needs to be repriced, in my opinion.
My
they're not a
guess
mature
would,
business.
I think a dividend right now would be extremely premature, and it could be viewed as a sign of weakness from the market as a whole, in my opinion.
now I've given a bear case, but there is a bull case to be made about Nvidia where they could end up becoming a giant cloud provider themselves. I mean, look, they've got the capital resources now to build data centers themselves. And they've got the technology to basically take any excess chips. So basically, right now, if Microsoft, Google, Oracle, and anyone else stops using their chips or it uses less, they could just use the chips themselves and sell the compute as a service, right? This is the real thing that you want, because this is what's going to be able to sustain your business for a long time. I mean, you can't have a system where you're just a hardware provider. If I had to guess what Nvidia's future plan is, it's around this right here. They are not going to just produce chips anymore. They're going to build their own data centers. They're going to build their own software like margins and margin revenues where they do hardware slash software as a service, and basically provide all the compute via their own data centers. So this is something that just we have to keep an eye on. They're not a data center play yet. They sell the data center stuff to these other guys, which is funding them right now. But eventually, I think they're going to get to a point where they're going to have their own hyperscales. They want to become a hyperscaler in the future. So I don't know if you guys have ever played any video games on Nvidia's cloud service. Have you done that before?
No, not on their
No,
cloud service.
Yeah, they have gaming where you can actually just go log in and play games over the internet using a cloud service. I mean, hold on one second. Let me show you guys what it looks like. NVIDIA.
Yeah, I mean, I have an Nvidia gaming chip in my
Yeah,
computer in my laptop. I have a
yeah.
3070,
No. So this one is
but not over the internet, not over the cloud.
yeah. This one is over the internet, so you can just log in and basically play all your favorite games. Now, the thing is, all the compute is done at the point of compute, and basically you have a stream just coming to your computer. So now, even an average computer, you could play like a AAA title, right?
So
And you would
are
just
they licensing this, or are they buying the IP, or?
No, they would license it. So basically, like, let's say you wanted to play Cyberpunk, right? So they would license. So Cyberpunk would be on the platform, in which case the person could use, I guess through Nvidia, buy an account and then use it to play Cyberpunk. I'm not sure exactly how it works, but
I'm
yeah.
curious about that, Chris, because I don't play a lot of games. Like, I
Mhm.
might choose between 2 or 3 games, but some of these games, like I just downloaded the new Call of Duty Modern Warfare 3, and it's
Yeah.
like 150 gigabytes. It's not
Yeah.
small. And
Oh yeah,
so
yeah.
this
No, it
this
sucks. It
laptop I'm
sucks.
carrying around is like two terabytes or something like that. So you get a few of these games on here, and it's a huge pain in the ass. So it's like if you're able to
Yeah.
just game on that and switch between, it makes it a lot easier, because even with two
Yeah.
terabytes, I do a lot of video editing and stuff on here as well. And it's
Hmm.
like my computer is already almost booked up. So I need to like go through and get rid of some stuff. So it's like if you're able to do that on the cloud and not have to actually download it to a hard drive or an SSD, that's hugely competitive.
There's only one problem with this, in that if you are a like a hardcore gamer, The one thing that you're not going to like is the latency, right? Because there is some latency between your computer's internet connection to their data center. I didn't notice any like lag, but if you're playing a highly competitive game, the lag can get up there, I suppose. But you can see here, like you're basically renting a 4080, right? And you're paying $99 a month for 6 months, which, believe it or not, is actually not that bad. You get 120 FPS, 4K resolution. You get 8 hours of gaming on it, which I think is more than enough per day. Well, not even per day, just per session. Yeah, and you could try it for free. Try it.
That's pretty interesting because I mean it's a 480 today, right? But who's to say?
Yeah.
I mean, they're coming out with the 4090, or maybe they already have, but they're probably coming up with the next rendition, right? So it's like to pay $99 a month instead of was it $99.99 for 6 months, or is it $99.99 a month for 6 months?
No, $99.99 for 6 months. Like it's not. Yeah,
per
cheap. Month is only $20.
That's really cheap, considering like if you wanted to have a competitive gaming card, like a 4090 or something, you're looking at thousands of dollars, right? Those things are cheap, but they're not cheap because you're competing against people that are trying to use it to mine cryptocurrencies and God knows what else. So they're expensive.
This is all high margin revenue. So in the future, my thing is their goal is to become more subscription based and software based so that they can keep enjoying those margins. Like the one thing that sucks about being in hardware is that you don't want to become this cyclical business. And this is where we should probably see if Dom wants to come on one day and actually give us an explanation, because I think Dom works on the software side of things. So he understands what the true value of NVIDIA is that we could be missing, by the way. I'm not even saying that I'm the genius here. Dom's a
concentrated guy, right? I mean, he has like 2 or 3 big stocks, Palantir, NVIDIA, and like 1 or 2 others. So he probably knows the lowdown definitely more than me, and you know a lot more than I do, Chris. So with respect to NVIDIA, what's going on there? Well, we can transition.
I have a question for you guys, if you don't mind.
Yeah, exactly.
I like to ask this of all seasoned investors, and paying you guys a compliment because I've been in the game for over 25 years. And I feel like you guys definitely have a wealth of knowledge. So I'm going to pose this question to you because I pose it to myself almost every night. Why does it seem easier, and I'm going to use the term easier on purpose, to invest in a company that is not yet proven? So where you can pull the trigger, I'm going to use an example for you, Matt, Rocket Labs. I'm going to use an example for me in SoFi. And then I'm not sure what degenerate shit Chris has done with his portfolio, but give me one that's not profitable yet. Huh?
Upsellera.
Okay.
I have ABCL. Yeah.
So that one. Why is it so easy for us to pull the trigger on these companies that are not yet proven, but we'll sit here and deliberate for hours on a fucking company that just beat earnings by $2 billion? Like, what is wrong with us? I know deliberate Tesla's valuation until I'm blue as my fucking shirt, but I'll buy 20,000 shares of SoFi yesterday and not even think about it. So like, I feel like there's just a defective component in all of us a little bit, because I think we're looking for the next Teslas, the next NVIDIAs, versus I think Carlos is famous for saying on Finance Junkies that Tesla is the next Tesla. So give it a crack, Chris, because I know there's.
I already know. I already know why. It's because as humans, it depends on your personality. If you have an optimistic personality, you're always trying to find the next new thing, right? It's exciting. There's chemicals in your body and in your brain that want you to have this feeling of excitement, right? And the thing is, like, we could invest in boring old companies like Coca-Cola, but that doesn't give you that excitement, that rush to see that, hey, you were right. So I think what it is that we have been trained over our investing careers to get that quick dopamine hit. And it's hard to control that feeling, that fucking rush that you get when you see your company going up 20%, 30%. And sometimes we're looking for that, right? So we are junkies, if you think about it. We're looking for that dopamine hit. And it's one of those things that if you look at, like, and I caught myself doing this, where I will wake up in the morning. The first thing I do is not say good morning to my wife. I'll look at my Robinhood. Like, as fucked up as that sounds, like I should be looking more forward to seeing my wife in the morning than I do my stock portfolio, right? But at the end of the day, the happiness of seeing my green is so much more than happy than seeing my wife, which is kind of sad because technically that means that I should probably like cut back a little bit. But it's just, this is what the market fucking does to you. And so you have to get that rationalization. You have to take yourself away from that a little bit, figure out what's actually important. And in the chat, guys, admit it. The first thing you do in the morning, you don't say good morning to your fucking lover or spouse. It's like, let me check my Robinhood, because there's a fucking feeling of, yeah, today's the day. Woo, And then if you're having like a fucking bad day, like, it's like a red day, you're just having a shitty day. And hopefully that person is there. And that's when you're like, hey babe, good morning. How's it going? I love you. I made you breakfast. Cause you that's where you look for that validation. But I don't know. That's just me anyway. So if I'm extra nice to my wife in the morning, it's probably because the market fucked. And if I'm just like, hey babe, how's it going? Just chilling. It's probably because I'm green and I'm like superior to myself. I'm like, yeah, babe. You with King Chris
him.
today.
I'm him. I'm the Daisy God. I'm him.
But it brings me to another question, Matt, and I'd like for you to answer because I know you're pretty high conviction on Rocket Labs, which isn't close to making a profit. But why is it that we're so relaxed when it comes to valuations on companies that are way more speculative in nature versus like I've been grilling the shit out of Palantir on my pod, bro. And I'm angry because I only got 18,000 shares. And for me, those of you that don't know, that's a small position. I wanted 100,000 shares, but I couldn't fucking commit. I just couldn't commit, dude. I put all the time in. I did everything that I was supposed to do, like learn about the thesis, and I even learned about Alex Karp and all the bullshit and why they named it Palantir because of Lord of the Rings. I mean, I went above and beyond from what I like to do as far as research, but I couldn't pull the trigger because I was always stuck on this valuation metric. For a company that's got $3 billion in cash and no debt, but with SoFi, oh, fuck it, we're good. I'm betting on Anthony Noto, and it's like no rhyme or reason for doing it because right. I mean, spade to spade, Palantir is a much more solid company that's like a for sure thing, in my opinion, versus like a SoFi that is extremely speculative in nature. But why are we so stuck on these valuation metrics on companies like Tesla and NVIDIA for this conversation versus on like the Rocket Labs of the world or the one that Chris just mentioned in my beloved SoFi? Like it's almost like we give them a pass on valuation because we're betting on the come.
I think it's so for me. I think it's a little bit more about how I've transitioned in my investing career. So like when I first started in 2013, 2014 in the oil and gas industry, you probably remember TJ, it was a pretty volatile time in the industry. A lot of people, unfortunately, probably friends and family that we know, lost their jobs. So I'm 22, I'm just getting into the industry. I'm like, oh shit, I need to make sure I have some cash coming in the door, right? So back then I was very much more, I need a company that's stable. I need a company that's paying me a dividend. And I would look at Google and Amazon. I'm like, doesn't pay a dividend? Not in my portfolio, right? Like that's the kind of guy I was. So I was investing like a 75-year-old fucking guy when I was sitting here being 22 years old, just based off the fact that I see, unfortunately, people losing their jobs and livelihoods right in front of my face. I went from being able to order like a $25 Macallan 18, no problem, at the Christmas dinner in 2013 to a year later, people being like, hey, Matt, it was nice meeting you for the past 18 months, but, I just lost my job and unfortunately I got to go home and tell my kids, right? So that was where I kind of like, 10 years ago entered the industry. Now I've gotten to a place where I recognize just the opportunity cost that I've lost out on by not investing in companies like Google and Amazon and only focusing on value stocks specifically. And so with that, to me, I've recognized that I don't know what I don't know a lot of times. So I should hold the majority of my money in an S&P 500 and let that kind of just do its thing. I do well with respect to getting a decent income from my 9 to 5. Just let that be the base mark, the benchmark, and then I can focus on something where I have, let's say, the majority of my time into companies that I truly feel convicted about. And that's where you get to Palantir, Rocket Lab, Dutch Bros. What's another one that I've invested in pretty much? And I think those are the real ones that I'm kind of speculating on right now. But that Palantir, even for me, was because I've worked with the company. And so there's been a few speculative plays throughout. Uh, I guess the past 5 years or so since I've kind of started veering down this path where I've just completely lost my ass. Wish is a good example where I was like, oh, this thing's gonna go to the fucking moon. Amazon's gonna buy it out. It's gonna be a smaller portion of Amazon. And just like Hims, which kind of concerns me as well, they spent so much OpEx on the marketing budget that it was inflating the revenue numbers. Any dollar that they would get, they would spend $2 on marketing to be able to get their monthly active users up and stuff of the like. So it gives you these, and it's like investing in any company, and exactly kind of what you're going back to. It's learning the actual key metrics and key performance indicators for particular sectors and understanding what's bullshit and being able to kind of decipher what's important and what's not. And so for me, like looking at a Rocket Lab, when I compared it to all the other opportunities that were out on the market, Astra, Relativity, Virgin Orbit, they didn't have nearly the cash kind of going into it. One, and then two, they were successful in what they were actually generating, launching vehicles since 2017, way before they went public via SPAC. Rather than an Astra, a Relativity that were all kind of like, well, we'll try to launch something, but we've never really been there. So it's kind of like investing in a Tesla after they've already created an EV. And back in like, let's say 2016, 2017, it's like they're losing money, but they've created an electric car. People seem to like it versus investing in a Rivian where you're putting a crap ton of money to work, but they haven't actually come out with a product yet or actually haven't sold anything yet. So it's that sort of thing, or like a Lucid where you're investing in a company that actually hasn't created a product yet.
Right.
So it's kind of like understanding and kind of getting to that piece for Rocket Lab particularly. But it's like any other thing, and I know where you're kind of headed with this, which is like, how do you know how to appropriately value a real estate investment trust? How do you know how to appropriately evaluate an oil company? How do you know how to appropriately evaluate any of these other companies? And the God's honest truth is like, you don't ever really know for sure, right? You can give a good inkling of to like what you think is appropriate for the sector, but you're always going to have outliers. Tesla is a car company that trades literally 3 times as much as a Toyota,
Right.
and they make I think Tesla makes about $5 to $10 billion less on an annualized basis. So why isn't Toyota worth $800 billion like Tesla? You
That's
start
because
having
you just started a war, bro. Now the Tesla bros are gonna come after us.
they could feel free.
Tesla's not a car company. Tesla's actually a technology company. They're gonna come after you now, bro.
Hot Steve.
See?
Steve's here. He's
There he is. The voice of reason is here.
No, Steve is the cheapest man in Babylon. That's what he is. He's the cheapest man in Babylon. What's going on, Steve?
I feel like I need to put my glasses on so I can fit in with
Steve. Steve, do you hear us? Not if you hear us, Steve.
Blink twice.
I don't think that's going to help. I don't think he hears us. Okay.
He'll be back. That was a voice of frustration. But anyway, I know I didn't answer your question appropriately and directly, but I think that gives you maybe a little bit of background. And I want to say also, just because I'm investing in a Rocket Lab doesn't mean that somebody else should.
Right.
I think everyone has to run their own race. And, just like how, to me, when I look at you and your portfolio, I look at it more like it's more about the income and the theta that you're generating than really, and you're just more so looking at, and this is the beautiful thing about trading options that I love. When you sell options, especially when you're selling options, you're doing the one thing that is constant, no matter what. You can't change it, and that's time. And you're
Right.
using it to your advantage. It's a treadmill, right? If you're
Yeah.
selling, that treadmill is always going to be in your favor. If you're buying, the treadmill is always, you're going to be always running against the treadmill, right? Where
So
you're always, and that's the hard part that I think a lot of people don't recognize. But it's the same sort of thing. I mean, you just have to recognize what strategies work well for your style, what helps you sleep well at night, what's your objectives. So I think that, there's no one size fits all, because if there was, I mean, we'd all be trillionaires, right? But I think what you need to recognize is, what works best for you, and it could very well be more mature companies are better. You could swing trade, find a company that's out of favor, make your 10-15%, sell it, and go to the next one. But to me, I like to find companies specifically now, from a speculative perspective, companies that are on the precipice of getting their cash flow break even
right.
and starting to get to a place where they pivot. And I did a little early with pounds here. I probably could have waited, but I think I was so excited because there's a company I've worked with in the past, and then now I kind of recognize that with SoFi, and I also, it's not SoFi. Well, SoFi is getting there as well. They're generating about 400 million in EBITDA. So I think they're getting into a good spot as well. But I meant to say, I think Rocket Lab will be there in the next year, which I'm excited because it's been trading rather cheap. And I think once it gets to that point, it's going to pivot and it's going to kind of explode to an $8 to $10 stock. But I could eat my words on that. Within the next 12 to 18 months, I think it'll double in value. And I think Dutch Bros is getting to a place as well where they are net income positive, but they're just spending a little bit more on a cash flow basis than they make. And so I think they're getting punished for that. So
what does our
I think
portfolio look like? What is the Patreon? Not Patreon. What is the portfolio doing?
we're only up 3.5%, hot Chris.
No, okay. I mean,
I'll take
after
a screenshot.
after today's drawdown, and maybe this is where TJ, you can take a look at our portfolio and tell us what you think.
Yeah, and I'm gonna read off 8 names because I've got the infinite 8 because 8's the number of infinity. I wanted to create a portfolio that I think would rival the Magnificent Seven. That's been my mission since I got on YouTube. So I'm gonna read these names to you guys and let me know what you think.
I'll give it the thumbs up and down.
I borrowed 3 companies from the Magnificent Seven because if you can't beat them, join them, bro. That's just the reality. Okay. So I have Enphase, Tesla, SoFi, Palantir, PayPal, Riot, Amazon, Google. The only company that I'm underwater on right now is Enphase. I've got a cost basis of 139, and I'm giving you all the big Robinhoods, 11,000 shares. I have a cost basis of 139, adjusted cost basis of 120. So when you subtract all the premiums, I'm in it for 120. So a couple more green days theoretically, and I could break even on Enphase. I totally plan on trimming the position to 5,000 shares on Enphase. It got bigger, not intentionally. These shares got put on me prematurely. These were all cash care puts for January 2024, but you don't control the counterparty. And they were like, hey, congratulations, you're the proud owner of a shitload of shares of Enphase. And at one point, I was down like 700,000 on that particular position. It wasn't a fun time. And that's where I learned something from Chris Patel. I want to give Chris Patel his flowers. You really have to understand where the sector is in that particular hype cycle. Because I really thought that 130, dude, was going to be a steal of a deal. I didn't realize the market would give me $75. I'd have had 20,000 shares, but that's just where I'm still just trying to get better as an investor. But looking at y'all, so it looks like you guys have ABCL, really good, AMT, Golden, love Dutch Bros, CCI. You're not going to go wrong there. Disney, I don't like anything about the company, but the stock is undervalued. Nintendo's golden. Rocket Labs, there's your risk play. TLT is absolutely golden. TQQQ, that's a leverage play, right? The triple leverage on the Qs. And then Verizon, I don't understand their balance sheet. Maybe you can speak on that, because every time I look at Verizon, I just look at a company with a shitload of debt that hasn't gone anywhere for several years. But at the same time, I was in the cell phone industry back in years in 1998 to 2001. And And I remember specifically being at a conference and there was a Nokia salesperson there, or the VP of Nokia at the time, actually. And they were like, there's going to be a time where people live on their phones. They get emails on their phones, the text messages, everything's going to be on their phone. And I was like, dude, what the hell ever? But I think that 5G is going to be the next, that's like the next plateau, if you will, of the cell phone industry and where it's going. So maybe Verizon is at the forefront of that. I'm not sure.
Let me share my information.
But I don't know much
guys
about financials, Chris, but I will tell you that on the surface, bro, their financials look like absolute dog shit. But
no, I agree. This is where you have to do some deep dive and some due diligence, and that's where you'll see true value. So share my screen real quick.
Sure.
Matt. So and Steve can help me out because Steve's a big Verizon guy too. We both spoke about this in length. So
how do I share? Oh, fuck.
How are you, Steve?
TJ, how you feeling?
Man, I'm feeling much better now that I'm home, sitting on this little puffy pillow because I've got another indentation in my butt that wasn't there.
Now that there's 4 people in here, I can't reach that. Hold on. Jeez. Can you, when you go to share, Chris, can you go to automatic?
Let me see. I understand. Share. Okay. Can you see that?
No. Crap. No. Now that we have 4 people in here, we have never had 4 people. This is why
there should be one thing there. If you go to your video, right? It should be there to. I don't know.
No, it is. It's just it's like there's no like little scroll button on here to like scroll down to get to the key.
Well, can you just talk us through the metric?
Okay. So the key here is that revenue for Verizon has been pretty flat over the last 3 years. But what happened with Verizon, and you kind of have to take a couple of steps back first to understand why they are in the position that they are. T-Mobile does not pay a dividend. All right. T-Mobile has been able to pool all of their money that they get into building out their 5G infrastructure. So T-Mobile was the smallest player about 13 years ago. You know, if you said T-Mobile 13 years ago, people would have said, bro, the only people who use T-Mobile are broke people. You know, so there was no real value in T-Mobile at the time, but T-Mobile was generating cash flow. They used that cash flow to really early on get into 5G. Verizon had invested so much money into 4G that they were kind of late to the party. So what happened was T-Mobile started to actually gain a tremendous amount of market share, and it was off the backs of companies like Verizon and AT&T and Sprint. So the key here is that number one, Verizon was losing market share, but they have a very strong business with regards to their enterprise clients. And even the people who have Verizon, they have a lot of like good, like my wife, she loves Verizon. Like I have T-Mobile and she will not give up fucking Verizon. She's just like, Mo, my signal doesn't work. She'll give me every excuse under the sun not to give up on Verizon, even though Verizon is more expensive than T-Mobile. Like I could add her to my T-Mobile plan. And it's like $15, yet she chooses to pay, I think like $100 to keep her stupid Verizon thing, which pisses me off, but whatever. Like
better, bro. I have AT&T. My wife has Verizon. Our phones work. T-Mobile does not work everywhere.
Yeah. So one of the key things that happened was Verizon was late to the party. Everyone got T-Mobile. And Verizon now, in order to catch up the last 3 to 4 years, they've been heavily investing in their infrastructure to get 5G online. And the way that they did that was, one, they had to buy all the spectrum from the satellite provider. So, you know, the satellite providers, they're assigned a certain spectrum that they've licensed from the FCC a long time ago. Now their business is dying. You know, people are not using satellite dishes as much anymore. So what happened was that all that spectrum became available, but in order for that signal, that 5G signal, to be broadcasted out, you needed to have those satellite providers clear up those frequencies. That finally started to happen now. So Verizon now has access to their entire full 5G spectrum, and they're reducing down their capex because there was a huge amount of money that they spent to build out the infrastructure, right? So think of it this way. When you go into the next generation of phone lines and all this other stuff, That is a lot of infrastructure that you have to invest in. Verizon has front loaded all of that investing, and they did it during COVID and a little bit after that. So they loaded up their balance sheet. Okay, there you go, Matt. You figured it out. Good. So they loaded up their. Let me just pull up their. Let me just pull up their earnings presentation. There we go.
I might not be able to get it back.
Oh, okay. Well, so they loaded up their balance sheet with a lot of debt. So if you look at their balance sheet, they've got a ton of debt.
When's the debt due, though?
Exactly. And I'm glad you said that, because majority of their debt is actually fixed debt that's super long-term in nature. So it's not like these near-term rate rises impacting them at all. So if you look at their earnings, it's not impacting them that much. So the key here
Zoom
with
in, my guy.
Huh?
Zoom in a little bit, my guy.
Okay. So the key here now is that
But are they tied to like any types of convertible notes? I mean, could there be a
no. Most of it is
that's all been done with. Like they had a problem with Vodafone like back forever ago. What was that, 2013, 2015, Chris? And they had to take on a shit ton of debt associated with taking over the UK or part of the business. And now that that's kind of out the window, there's no real like convertible or dilutive debt associated with this.
Yeah. So one of the keys right now to their debt is that it is pretty substantial. Right now, their debt is almost $147 billion in debt, even in 2023. But if you look at it, their unsecured debt is about 126, of which 4.2 of it is in cash. So their net debt is about $122 billion, right? The key here is going to be their free cash flow. Look at how much cash this business generates. Almost $28.8 billion of cash flow. And this is only in 9 months. All right. They're spending 14.2 billion of that in CapEx, which, by the way, they've guided this to be much, much lower in 2024 and 2025 as the build out of their 5G is pretty much done. So they're shifting from building CapEx to now maintenance CapEx. And their maintenance CapEx is usually about 16 billion for the entire year, 16 to 17 billion, which is what their historical amount is. After that, they have their 8.2 billion in dividends that usually comes out. That right now their dividend is really secure. So if you look at how much they're generating in terms of free cash flow of about 14 billion, their dividend is very easily covered. And then they still have money left over to pay down their debt, right? So this is not a problem for Verizon, that they have all this debt, blah, blah, blah. They're working on that debt reduction and they're doing it really fast. What excites me and gives me a little bit of cover is two different factors. Number one is this right here, their broadband net additions, okay? This is the number of people adding fixed wireless, and also this is for the fixed wireline, so like Fios and stuff. But you can see here that they're net adding almost 434,000 people per quarter to their broadband mix. So as now that this 5G, what is that called? 5G spectrum is available, they will be able to basically capitalize on this. They are losing right here prepaid net ads, right? So you can see prepaid is going down, but that's an industry trend that's not specific to them. And over here, they were losing for a little while some retail. They hired a new person to manage their retail business, who I think is going to do a phenomenal job. But overall, they're adding customers. That's the key that I want to look at right here, and especially broadband. They're adding a shit ton of people, and the margins on these things is super high. So it's not like you have to drop lines into people's homes to get the thing done, to get fixed wireless access. It's literally just a wireless router. You put in the apartment or the house, and boom, you're ready to go. And they're going to be generating a substantial amount of money from this. I don't want to bring up my Patreon, but I have a lot of this stuff put in my Patreon, and you can see the amount of CAGR that's going to be happening with fixed wireless access. And yeah, this is to me, this is such an easy play. Let me just hold on. All right, let me bring up some statistics from my Patreon, but
much appreciated, ETF FaceTime. It's always nice to be able to get a $5 from the squad to be able to look into this stuff. I think if you guys haven't already, Hot Chris's Patreon is in the description. Chris, while you're doing that, pulling up maybe some select graphics. Obviously, you don't want to share all your Patreon, because that defeats the purpose of having the Patreon and having the increased due diligence that people can sign up for. Do we want to talk about our thought that you were messaging me about late last night, or is that something we're going to save maybe for another day, maybe tomorrow?
Maybe we'll
or
save it for another day. But I'd like to hear your guys' take, especially Steve. Like, what do you think what I just said? Like, maybe you can add some color to it.
Yeah, can I share a slide?
Yeah. Hot Steve.
Yeah, Chris pretty much hit the nail on the head. So I'm actually going to show Verizon's debt profile. Matt, is it coming through? Okay.
It's just really small.
Yeah, you just got to zoom in a little bit.
So let's see.
Might also help if you shrink the thumbnails on the left.
I should probably go into a different mode, right?
Or presentation mode, yeah, that might help.
May help a little bit. So, and I apologize. I saw your link when I woke up and taking a nap, so I'm half asleep and not.
You're good. You're good. You're good.
Moment. But Verizon has 150.64 billion in long-term debt right now. 12.95 billion is due over the next year, which puts it at 12.95 billion plus another 134 billion of long-term debt on the balance sheet. So they had 4.21 billion in cash on the balance sheet at the end of Q3. They are projected to generate 19.76 billion in earnings. So I normally do free cash flow, but I'm going to do earnings because I broke out the dividend. So they pay a $2.66 dividend per share, which comes out to 11.18 billion of earnings. After paying the dividend, based on what they're projecting for their earnings, they're still going to retain $8.58 billion on an annual basis if these numbers stay static. So when you look at the debt profile, they have 46.26 billion in debt coming due through 2027. Between the cash on the balance sheet, the retained earnings over the next year, because that's not through 2023, that's through Q3 of 2024, there's more than enough powder to get rid of their debt maturities over the next year of 12.95 billion. And then on an annual basis going forward through 2027, they have enough to not just pay the dividend, but also take care of all their debt obligations. So people look at 150 billion on the balance sheet and they freak out. And that's part of the reason why Verizon's share, my opinion, has gone down so much. But most people don't take the time to tear through the numbers. And as Chris said, look at debt being fixed. And if you look at these interest rates that the debt is fixed at, I mean, these are not crazy rates where a lot of the debt is fixed. And then debt that's further out, they can buy back at a discounted price if they choose to, much in advance in the future. So the debt scenario is not nearly as crucial as some are making out to believe, in my opinion. And this is a company that's projecting 18 billion free cash flow. As Chris said, CapEx is going to go down. They're at the end of the spectrum investment. I mean, it's hard to bet against a company that's generating 19 billion in earnings after all their expenses and 18 billion in free cash flow.
The other thing to also keep in mind, the 5G fixed wireless access market is going to CAGR at a fucking 40% year, like growth rate. So they have right now a good amount of market share, but they're going to be growing their market share on top of a growing pie. Look at this, just giant stream higher. This is what you want to be in. So they're returning to growth. They're priced like a value company right now. The other thing is they're also in line to start doing share buybacks in 2025, because all they really need to do is get their debt to EBITDA down below 2.25, right? And if they wanted to get it below that, they'll end up starting to buy back shares because they have massive amounts of cash flow that's coming in. So When you factor those things in, plus even the debt that they have, some of it that's floating, with the interest rates coming down, it'll benefit them again. Because it's like, oh yeah, the floating rate debt that we have that we're paying higher fixed costs on, it will go down, which means that that money will fall right back down to their bottom line again. And the other thing is, if we get hit by a recession, you want to be in defensive companies. Right now, no one is going to cancel their cell phones during a recession. Everyone is going to be maintaining that. So if you look at the year to date in early part of 2022, when we had technically a recession, but the Fed didn't want to declare a recession, Verizon held up better than the S&P and the Dow. So I want to be in a defensive company that's deleveraging, also pays a really good dividend, right? And then on top of it, one last thing, people are going to be chasing this goddamn yield. A 7.5% yielder today seems like bullshit because you're getting 5.5% from a 2-year treasury. So people are okay. But the minute that the treasury starts lowering their rates down and short-term rates goes down to nothing, people are going to say, hey, I want to get a 7.5% return. Where do I go? You go to Verizon, and Verizon's been raising their dividend every single goddamn year for the last 17 years at about 2.5% per year. So, like I said, this one is a no-brainer. On TJ, I'll send you some information about some of their options. Their options are wildly mispriced.
So I mean, you're saying that it's a 7% dividend, but if I look at the 5-year chart, they're down 37%. So I mean, it's like if I'm going to lose 37% on my actual investment to pick up a fucking 7% divvy, let's say it's a 15% divvy because I can sell options against my shares and sell puts on shares that I'm potentially willing to buy. I mean, am I even beating the denominator at that point, though? Because I mean, I always look at when I look at investments, we're talking about the holdings that I have. The reason that I have the holdings that I have in the portfolio, guys, is because I'm trying to figure out what can I do if I'm going to manage this portfolio. I have to outperform the Qs. I got to outperform the SPY. That's
TJ. After we have this call, I will give you the inside track on some of the options part. This is not a company that you want to wheel and deal on. It's not going to work out well with the wheeling strategy because the options premium, look at them and they're complete garbage. Complete garbage.
Like
there's very low volatility to the stock price. But I think what Chris is kind of talking about is obviously we have been over the past 18 months to 2 years, a rising interest rate environment. So people are leaving companies like Verizon to go to more secure sort of assets that might be higher growth or just less capital intensive, which this obviously has $100-some billion of capital that scares people, or sorry, debt that scares people. So people are leaving in droves. But I think what Chris is trying to say here is they have more than enough cash flow left over at the end of the day, and a changing business model. They don't no longer have to lay these tens of billions of dollars worth of fiber optic cables or any of these other lines that they used to have to do in the past, because now everything's going to wireless. So when they pay off this debt, a lot of that's going to stay paid off. And so I think what Chris is saying is there's going to be a resurgence in the net margins of the company and a lot less capital necessary kind of going forward than what's probably been necessary in the past. And so that's kind of my interpretation. I think people might be like, well, what about 6G? What about 7G? You think about it, it's all going to be wireless. They don't have to go and switch from a fiber optic cable to a different cable or anything like that and go around the country. They just have to switch out, say, to the emitters that is a lot more wider spanning than having to hook up to every single line, underground and all that kind of crap that they had to deal with back in the early 2000s and the 2010s, and even way before that, right? So it's just initial kind of from a rudimentary perspective, kind of breaking it down in that way.
I want to just highlight one thing. Someone brought this up, and this actually was something that I had to research. Someone said the future is satellite connection, satellite internet, like connecting through that, where it connects directly to your phone. That is completely false. It's wrong. It's not going to work. And let me tell you why it's not going to work. Number one, there's a lot of latency between the phone and the satellite itself. So if you want a direct connection directly to the satellite, dude, it's a lot of power that you have to generate just to get a signal up there and then to take that signal and then bring it back down again. It's not as easy as people think. That's number one. The other thing is the amount of bandwidth that's allowed to go up there and come back, it's a lot more limited than people think. That means that you need hardline fiber optic connection and then be able to distribute that signal. So it's a lot more limited than people think. So the total addressable market, and even SpaceX has said, like, look, our total addressable market is about 5 million clients. After that, we can't do much with it. So the use cases for SpaceX's Starlink and all the other stuff is going to be locations that are so remote, like a cruise ship or like in the middle of like a national forest. Yes, people will be able to accept that. But and even the bandwidth that you get is going to be like 10 megabits per second, not enough to run your home internet off of. You know, if you've ever lived in a rural part of the world, they've had satellite internet there, like this thing called HughesNet. But do you know what the bandwidth that you get on those things is? It's complete. I mean, TJ, I'm sure you know about this because of your background in that industry. What do you think about that?
There's definitely a lag, and then anytime you're dealing with the satellite guys, it's like I was an authorized retailer for DirecTV and Dish Network for many years. You're dealing with weather. It's a weather component that doesn't really exist now. And I just don't think that the mass audience is going to go for that, because the one thing that people need that's reliable, because it's like an appendage, is they need a reliable cell phone. Mm-hmm. Like they need to have a reliable cell phone. If that's not going to be reliable, they're not going to do it. Someone asked if I owned ABCO. I do not. I just mentioned the 8 stocks that I currently own a little while ago. But the one thing that I do want to ask, and I want to get Steve's take on it, because
Steve.
He mentioned a company to me when him and I did he was kind enough to come on my channel a couple of times, and he mentioned a company that he thought was extremely undervalued, and it was one of these .com darlings. So he knows the company that I'm talking about.
I'm going to assume PayPal, but I'm probably wrong.
Cisco.
Oh, Cisco, yeah.
Cisco is a .com darling that has just never returned to its former glory. And I think that we can all agree that Cisco is a much better company today than it was when it was getting these ridiculous valuations. So the reason I'm bringing this up is because my co-host for Power Hour, Robert, he says, how many turnaround stories do you really know that have been successful? Like a lot of times when companies fall out of favor for whatever reasons, because we don't invest in a vacuum, and there's something to be said about market sentiment, right? And market sentiment is like a thing, I believe. Like how many Cisco's have like really turned around? We're not talking about the company, we're talking about the stock.
I'd say Microsoft is the best example of one.
Yeah, because I invested in Microsoft in 2008, and one of the best investments that I've ever made. But I got a lot of egg in my face for a while I was holding that investment, and it took about 5 or 6 years for it to play out. But like PayPal is one that I'm I wouldn't say heavily invested. I think I'm up to 5,200 shares in PayPal right now. It's one that I wanted to 20,000 shares. Like I totally see the double, possibly a triple if it just reverts to the mean. They're buying back the float. I listened to Steve's take on it, and it just made all the sense in the world to me. But then I went on Alpha Spread and I started looking at the metrics, and I'm like, okay, hold on one second. This company isn't growing at a rate that it used to. The margins have compressed. There's a lot of key players in the game now. And on top of that, their sexiest product for me is Venmo, and they can't even monetize it. So it just gave me cause to pause a little bit and be like, hey, maybe PayPal's priced where it is for a reason, because they had to hire this guy, Alex, that came from Intuit, and he has a real big job on his hands. Like the company is a little bit broken right now. So just based on that, like is Verizon, like what's their leadership? Like what's the situation with Verizon? Like why is it getting its ass kicked compared to the S&P 500 for the last 5 years? So just looking at that metric, because at the end of the day, we have to buy something for $1 and sell it for $2. That's how we make money, right? So
there's a lot to unpack in what you just said. So,
I hear you, and that's why you're the right man for the job, Steve, because you understand these metrics better than I do. But
so let's start with Cisco. I need to reread Cisco's earning report. They missed earnings. They came in with lower than what the street wanted for guidance for 2024. And I need to really look into that. But Cisco's still a great company, but it's the quintessential example of what you're talking about, because this is a company that was the largest company in the market in 98, 99. A lot of people were saying that this was going to be the first $1 trillion market cap company.
Right.
And 23, 24 years later, it has still never recaptured the market cap that it once had. And I don't have updated numbers, so I'm not going to give hard numbers. But this is a company that during the hype was generating billions of dollars of profit. And this is a company that's generating tens of billions of dollars of profit now. I think they've bought back like 30 or 40% of the shares outstanding over the past decade or maybe 15 years. They allocate billions toward the dividend, billions toward buybacks every year. From a financial standpoint, it's everything you want to see in a company. It is a perfect example of a company can do everything right, but
Right.
the market is the ultimate decider, and the market's deciding that it is not worth the bid. What chart is this?
This is shares
Shares
outstanding.
outstanding. Yeah, it's crazy how much they've bought back. I mean, it's just they do everything right. Huge cash flow, huge earnings, huge revenue. It's a company that continuously grows. I don't know. It's a broken stock, not a broken company. And I don't know that it gets back to where it was in the next 10 years. It hasn't for the past 23. I mean, I own it. I'm not getting rid of it. I'm just compounding the dividends, and
Right.
hopefully it works out. As
I'm
far
just
as
looking at the headlines. Looks like it's trading at a 15 PE, so it's making about $13 billion a year.
yeah,
Just
the
off of
valuation's amazing. But once again, it comes back to certain things. It's not in a sexy area. It's not grabbing headlines. You don't have volatility around it. You don't have a lot of catalysts to help push it higher. And it's just not something that people get excited about. You know, networking's not exciting, even though it's the backbone of business. So that's Cisco. As far as Verizon, I would echo some of the things I said about Cisco, that it's not a sexy industry. Telecom is looked at as the 2023 utility instead of a utility company. I mean, telecom is a utility.
Yet every single person
Needs one.
needs one. Yeah.
Yeah, it's
Yeah,
the
you
last
can't.
thing you're getting rid of.
Yeah.
You're not getting rid of your freaking cell phone. You're getting rid of Netflix before you get rid of your cell phone.
Right.
Internet. Now you have the internet with the component to it.
Yeah, it's just non-exciting company. And you got to remember, we're in a time period where so many people just want growth. And how
Mhm.
many people just cared about revenue increase without fundamentals? I mean, part of investing is broken right now. And when you have the Fed raise rates to where they are, I actually have a chart here about the money. Chris and I were talking about this 2 days ago, I think.
Mhm.
So this chart is money market accounts, not CDs and not bonds, straight money market accounts. There's $5.8 trillion sitting on the sidelines in money market accounts right now. When the Fed pushes rates and you can get over 5% risk free, there's much less of an incentive to put your capital to work in the equity markets to generate yield. And Verizon has been a yield play for God knows how long. Same with Altria Group. It's been a yield play. There's less of a reason to take risk. And you can get 5.25 risk free and sit on it. But with the Fed starting to look like they're going to cut rates, let me stop sharing. Whoops, wrong thing. All right, there you go. So with the Fed looking like they're going to start cutting rates as soon as March, and for sure around June based on CME Group. I mean, I want to see what Powell says next month, because the minutes still do not indicate any type of cut. Whether he's bluffing or not, guy's got a great poker face. But when you start seeing rates come off of that 5 and you get a 4 handle in front of it, and then you start getting to the low 4s, I think you're going to see money pour into the markets, because they're going to remanufacture that yield that they're used to getting risk free. And when you get a 3 handle on rates, I mean, a 7% dividend from a company that has 18 years of dividend growth in Verizon is going to start looking pretty good. And I think you're going to get an income crowd that starts pushing up REITs, telecoms, MLPs like Energy Transfer, and some other ones. It's just
Yeah.
for
And
what
that's with the
TJ does, I don't think Verizon makes a lot of sense.
yeah. And there's also a background. This is under the backdrop of all these boomers retiring.
That
Where do you
need
think they're going to
fixed
park their
income.
money? They need fixed income. If they can't get it on the treasury side, they're going to go into the corporate side, right? So this is where the opportunity is.
Yeah. And I think that was evident. I mean, just from 2013 to 2020, a lot of these companies that historically in the early 2000s and early 2010s, they were trading at 2.5% dividend yield. They got pushed up to, they were trading at 3.5 to 4% dividend yields. They got pushed down to 2.5% because nobody had anywhere to park their money because treasuries weren't paying a damn. And so now that's kind of, you're starting to see a reversal in some of these opportunities because now they can leave those stocks and buy something that's risk free. Like Steve mentioned, our money market account and the public account is trading at 4.99% yield. So it's been 10 years basically where your savings account wouldn't pay you a damn except for the blip in 2018 where you got back above 2% in the savings account. Now you're actually able to just sit on money and actually just wait something out.
And
It
think about
wasn't
how crazy
advantageous
that
10
is.
years ago.
Because you don't even have to lock it up on terms with a CD
Yeah.
or a bond. You're just getting that rate on just loose cash.
It's way different than when I started 10 years ago. Way different.
I
It's
mean, dude,
wild.
5 years ago, go back 5 years, and you would
Yeah.
someone would have told you a 7.5 yielder that's secure dividend from and with cash flows that are literally only about 50%. Everyone would have bought it up, and that's why Verizon was trading at $60 a share. Right now, it's drawn down to $30, and I was like, holy shit. Bro, I've done exceptionally well on Verizon, and I think it's going to do exceptionally well. It's going to go back to I can't say it's going to go back to the 60s because at the 60s, the yield was even crazier. Because what happened was the Fed was almost at near zero. So I don't think we're going near zero. It's probably going to be closer to like the terminal rate is going to be 2%. But if you think about it, 2026, you've got about two different dividend rises between that and 2026, right? With the Fed right now projected to be, let me just show the screen real quick. This is the Fed CME tool with the projections. Can you share this?
You're
Real quick?
bringing up FedWatch.
Yeah. Right here. So we are over here. Right now, interest rates are at about 5.25, right? So we're literally right there, 5.25. Next year, the projection medium is going to be about 4.5. I think this is highly, what's the word? Over optimistic. I think it's actually going to be even lower because the rate of inflation is coming down much faster than a lot of people were expecting. And then over here in 2025, it's going to be down to 3.5. I think this is probably going to be closer to 2 to 2.5. And if this happens, that means that everyone and their mother is going to be chasing yield. And when they do chase yield, they're going to be buying up assets that generate dividends and have growing dividends. So if you look at Verizon,
dive into this chart a little bit more, hot Chris, because maybe people in the chat aren't 100% sure what's being shown here, and if you could zoom in a little bit, that would help as well.
Okay, so this is the assessment from the FOMC participants on where the Fed's this is basically a projection of where interest rates should be based on today's economic indicators.
This isn't inflation data. This isn't anything like that. This is what the federal funds rate is projected to be through time.
Right. So right now it's about 5.25, which means right now it's restrictive. If inflation is 3% right now, which is almost 3.1, and the Federal Reserve is charging on short-term treasuries 5.5, that's restrictive. The reason why is because the banks borrow from the Fed, and if it costs more to basically finance the debt, they have to charge consumers a higher amount to borrow, right? So banks have one business model. They borrow short, they lend long. So right now, if you go out to get a mortgage, they're going to charge you 8%. Why? Because they need to make a spread in between what they're borrowing and what they're lending out. So right now they're borrowing at 5%, they're lending out at 8%. They make a 3% spread for every dollar that's out there. When inflation is going down, the Fed is now incentivized to say, hey, let's kind of like take the foot off the pedal a little bit to make sure that we're not slowing the economy down to the point where we're bankrupting people. So if you look at housing prices right now are just out of this world starting to decline. Why? Because no one can afford an 8% mortgage with housing prices at all-time highs. It's just not possible. So you're seeing a lot of economic stagnation happen in the background. So now the Fed says, look, maybe we're a little bit too tight. Next year, when they start cutting, they're going to say, let's cut a little bit, like a quarter basis point, so that now we can get closer to inflation, to that magic inflation target of 2% without screwing over the economy. And that is going to be the goal. Overall, according to the projections, we're looking at a Fed funds rate of about, in 2025, on average, about 3.5, which means that mortgages should be down by that time to like 7 or 6.5. But
That's
also,
probably 2 points over around.
yeah, but this projection is changing all the time. This is the one thing we have to keep in mind. When economic indicators are pointing towards weakness, you're going to see this come further and further down, because this is what's based on today's prices, not based on what it currently. I mean,
Match.
they're basing. Yeah, sorry.
So, and to echo what Chris said, we could be heading into a recession. And if we're
What exactly are you showing? And if you could zoom in, that'd be nice.
Yeah, so let me go on presenter again for this.
Shout out to 100 people in the chat, my guys. Thank you. We've been toying with it all day. It's a great achievement. Thank you all.
So basically, what could help the Fed have more of a reason to cut, like Chris is saying, is to stimulate the economy in the face of a recession. So there's two economic indicators that a lot of people utilize, and it is the inverted yield curve, which I dislike, and unemployment, which I do like. So what I have up here is the 10 and 2-year Treasury inverted yield curve with the gray shades as recessions. Typically, except for now, which is over here, every time we've had an inverted yield curve for at least 3 months, a recession has followed. Every time since over the past 4 decades. And I could go back further if I use a different site, but I like St. Louis Fed because you can't really argue with their data. So every time except for now, a recession has occurred. Now, if you look at unemployment, I was able to go back to 48. And going back to 1948, without fail, if unemployment goes up by 1% or more, a recession is imminent and follows very quickly. Unemployment is up from 3.4% in June to 3.9% at the last reading. If this continues to tick up and business bankruptcies have increased for the past 5 quarters, quarter over quarter, we become much more likely to have a recession. And if we do, the Fed is much more likely to cut, especially with rates at 5.25 to 5.5 bips, for the simple fact that they can take 2 bips off over a year's period and still have a terminal rate that's 3.25, 3.5, which is still leaving a lot of bullets in the chamber in case they have to cut further in the future. So I don't see how they keep rates higher for longer past March or April with the data that I'm looking at from these different economic indicators.
I'm just looking for CNBC, what they were kind of plugging in for potential rate cuts, and I forget exactly what it was. I think it was like credit. No, it wasn't Credit Suisse. So maybe
No,
it
it was UBS and Morgan Stanley. UBS
Yeah, thank you.
out. They think it's going down by 250 basis
200.
points. Yeah.
I was, and at least for Goldman, they was predicting, or was it Morgan Stanley? I was predicting 25 basis points or two times.
Yeah, I have it somewhere in one of my articles that I
Trying
wrote
to
this
pull it up.
week. UBS had some crazy projections.
So, can you show this really quick, Matt? One last thing, and then I'll get off my Verizon my spiel about it, because I think I beat this horse to death. If you don't believe it at this point, I'm sorry. I can't really do much. This is Verizon's dividend yield for the last 17 years. Okay, so you can see consistently it's been between 5, 4, maybe sometimes it reaches a little bit into the high 4s, but it stays around there. The reason why is because every year they keep raising the dividend, and the inflation and the interest rates have been pretty much around 2% for the last 10 years. If we go back to that 2% scenario, that means that based on the price of the underlying stock, the dividend could go back to about 4.5%. Now, what does this mean? The dividend does not go down. Okay. The dividend is a fixed amount that gets paid out every quarter. So right now, the dividend is currently at 66 cents, right? So if you just do some quick back of the envelope math, if you go to $50 a share divided by, actually, it's going to be 0.66 times 4. Sorry, 0.66 times 4. That gives you about $2.64 of dividend yield, which means that if you want to go back to like a 4.5%, what is that they call yield, the stock will eventually appreciate to about, I would say, about $55. So what is it? 55 divided by 2.64. 1 second. Hold on. Oh, damn it, man. I'm just trying to.
But that's about where it
Yeah.
was before, right? Before the rate hikes
Yeah.
came in, it was trading around that price, which is when I had sold it. Not
Yeah.
because I thought or I'm a genius. I didn't think that, it would have this much of an impact on Verizon. More so what I was thinking was, why am I not putting this into something like a Palantir that I have a feeling is going to be able to 2 to 3x, right? So at that time it was like, okay, I didn't really foresee it really going to like a $70 or $80 stock, and so I took that money. It wasn't a lot. I think it was maybe had 100 shares or something like that. So it was like $5,000 or maybe $6,000, and I put that into like a Palantir or something like that. But that's the reason why I had sold out, not because I anticipated that it would be so decimated by what's going on with interest rates right now.
So, Matt, I found the data for you. UBS sees deeper cuts with the market. They're projecting 275 bips of easing starting in March. And Morgan Stanley's projecting that the Fed will reduce rates to 2.375% by the end of 2025.
Okay, so I didn't have the same one, but here's just a quick clip here. I'm curious to see what everybody thinks on this one.
The Federal Reserve will cut interest rates by 275 basis points, nearly 4 times what the markets are pricing in. Bloomberg's Abigail Doolittle is here with the details. Abby?
Yeah, Matt, this is a pretty dramatic call. I mean, if you think about it, that's almost saying that rates will be 3% lower around this time next year than they are now. Now, the justification that UBS is using is they're saying that they see this as a normal rate cutting cycle ahead. So again, they expect 275 basis points by the end of next year. They think that we could start to see cuts as early as March. And then they're saying that one of the reasons inflation's down, I don't know that this is a justification, but they do see a recession starting by the second quarter of next year. So when I have thought about why would the Fed potentially cut sooner than the Fed is saying that they might cut if there was a recession around, that could be one reason. Now, when you put that 275 basis points against the market, which is basically at 75 basis points by the end of next December, it's a really wide divide. But the widest divide, Matt, might be markets and strategists versus the Fed itself, because the Fed on at least 2 occasions has said they're not cutting anytime soon. In fact, if we go into the Bloomberg terminal and we take a look at a chart that shows the 2-year yield and the 10-year yield, here's the 2-year yield. It's a weekly basis. You can see the uptrend is in place. The 10-year yield, the uptrend is in place. The 2-year yield very firmly from a number of technical chart perspectives, Matt, looks like it's going to continue to go higher. The 10-year yield, maybe a little bit less so, but if the 2-year yield does hold that uptrend, it would very firmly suggest that the Fed is less likely to cut. But again, we have lots of strategists right now talking about big cuts to Fed funds rate next year.
So that said, I feel like, Hot Chris, are you paying attention specifically to UBS? Is that who you're using for your recession metrics that you're expecting? Because I think you're in the camp that there's going to be a recession.
Nope.
Whoop,
I'm using my
pretty-
own data points. So no.
I was curious. there's a wide range. I think a lot of people, the whole market looked like they were pricing in 75 basis points there. I'm on the realm where I think it's going to be pretty slow. I think you'll end up having like a starting mid next year, kind of 25 basis point cut and once per quarter. So I feel like you're going to end up with like 50 basis point cut by the end of next year. But Chris, I know you're kind of thinking about recessionary fears at this point with deflation potentially on the horizon. So I know that you're looking more towards the likelihood that they're going to cut more aggressively. Do any of you guys want to give a projection? I know it's always going to be wrong. I was massively wrong at the end of 2021, early 2022. I thought that we would end up at a terminal rate of about 2.5 to 3, and here we are at 5.25, right? But I had never really been a part of such a drastic I guess cycle like that before, right? I've only been investing for 10 years, so I think a lot of that could be attributed to my lack of experience.
I think the thing you got to remember is nobody can predict the future, and none of the strategists 100% know what's going to happen. We don't know what's going to happen. This is something I think about in theory rather than a projection. And the reality is that the average median household income in America is $74,000. When you use a moderate zip code, that's roughly $4,400 a month in take home. You have average rent of around $2,200, and the average American has credit card debt. Facilitating debt has only become more expensive. You look at the United States government, the debt payments are almost as big as what we pay for the military. I think there's going to be a lot of pressure, considering it's an election year, for the Fed to cut. I really do. What they do is a different story. They haven't blinked yet, and you can definitely make an argument that there is no need for the past several increases, and they could have kept rates at 4.5. There's certainly an argument for that. Look, Powell can jump rates 25 bips in 3 weeks and completely throw the market in disarray. And I think that a 6% chance is too low that he's going to do that. I would say it's 50-50, but who am I?
I don't know about 50-50. That seems a little aggressive, but
They were wrong
Chris,
the whole way. They don't want to be wrong again.
okay, I hear you that. Chris, I'm going to give you an exit ramp. I know you've been streaming for 2.5 hours if you want to go take a quick break. But TJ, I want to hear your thoughts. Chris, I want to hear your thoughts with respect to finishing up on the interest rates. And then I do want to dive in while we have Hot Steve here on his recent article on ET. So Chris, feel free to stay for that. TJ as well, if you want to.
I'll just be very quick, and then I'll head out. Housing prices are going down. Core inflation has pretty much been held up by housing because sheltered lags. Sheltered data is lagging, so that data is going to start coming out in the first half of 2024. In which case, everyone's going to be like, "Oh my God, inflation's dropping off the cliff. What's going on?" Well, yeah, all that shelter deflation is coming in now. All the numbers are being factored in. So you'll get closer to your 2% target faster than people are expecting, especially considering housing, depending on what part of the country you're in, is not disinflating. It's deflating, which means there's actual cuts compared to last year. So just telling you, once you hit deflation, it's going to take its toll on the inflation. So we're going to go from rapid inflation to rapid deflation rather quickly, and that's the thing I'm betting on. So,
and do you think we're going to end up in a seesaw event, Chris? And then I know you want to get out of here, so I don't want to hold you up too much.
Yeah, I think with AI and job losses, those are two main components. So AI right now is just optimizing productivity. Employers are looking at places where they can cut in order to make sure that they have, a decent operating margin. So right now you're seeing people that had 10 times, the number of people was like 10 people. Maybe they don't need 10 people. Maybe they only need 2. So you're seeing a lot of layoffs all over the place. And a lot of people don't necessarily talk about it, but eventually you'll see that come up in the data. And once it comes up in the data, it'll just shock everyone, in which case then the Fed will say, hey, let's start cutting.
But I meant a seesaw event as in, where we go back into a deflation mode and then eventually go back into inflation, and have that sort of seesaw event that I think a lot of people are predicting.
No, not unless I don't think we're going back into inflation. this inflation that we got was not even because of all the monetary stimulus. I think a lot of it was due to two things. One, supply chain crunches, which sent goods up in value. And when goods went up in value, then the service ended up going up in value too, because everyone's like, hey, listen, I can't afford to buy my basic core goods. So I need a higher wage. So now all the wages started to go up. Now the businesses are on the other end saying, hey, we can't afford these goddamn wages anymore. Let's start laying people off. And so the cycle begins the other way. So now people are going to have service deflation, in which case goods prices are already down, by the way. I don't know if you saw, goods prices are coming down significantly compared to what they were last year. That's not disinflation, that's deflation. So just, I don't know what else to say. Yeah.
Yeah, I think it's probably prudent. I mean, you're seeing companies like Pepsi and many others post double digit revenue growths, and it's kind of surprising. But a lot of that's just price increases. And Dutch Bros is a villain in that sort of territory as well. I mean, you look at their waterfall plots with respect to why they're able to keep growing their gross profits at the way that they have, and a lot of it's attributed to the menu price increases that they've been able to do. And I think because of what's been going on, I know you need to pass costs on to the consumer at some
All
point.
right, I gotta go. I'll see you guys.
Thanks,
All right.
Chris. Some people have taken just quite a bit of an advantage of it. So Hot TJ, feel free to stay, but you're more than welcome to hit the exit ramp. I know you were streaming earlier, and I don't want Boss Lady to
No,
yell at you.
she's asleep. She slept on a bench all week. She's
She's
in her
recovering.
sleepy
I
posturepedic,
do wanna.
enjoying life again.
There you go. Yeah, back in the homestead, which is good.
I think the Fed is done raising rates personally. And I think also that, and it's because my wife owns a small business and I have several friends in real estate. Again, this is a small sample size, though. This is just parts of Texas. But I think the consumer is actually a lot weaker than people think. I think they're carrying an enormous amount of credit card debt. I think that the housing prices are just not sustainable. It's very hard to get into a new home. We're closing on not even a super expensive home, did $500,000 home. And bro, they wanted everything from my blood type to the type of kidneys, what condition. I mean, it was crazy. It wasn't
What's
just
your
like,
sperm count? All these things.
here's my 750 credit score, a pretty decent net worth, it's a down payment. Let's go. No. I need everything. So that means that they're tightening the screws. They're tightening the screws. The mortgage folks are tightening the screws. It's hard to go buy a home because who's moving? Like who's moving? I want to say that like 60-70% of the people have a mortgage that's like under 4% or 5%. Correct me if I'm wrong, but it's very, very low in comparison to the 7% that I was just quoted on $500,000. Yeah. So the only place that you can go buy a home right now in Texas is you got to go to the outskirts and you got to go do new construction because they'll give you points. They'll essentially pay you to go move into one of their new homes. You got to deal with the builder though and use their mortgage guy. So it's just become really, really tough. And then in San Antonio specifically, where I'm talking about, nobody wants to live in those areas, bro, because all of the Stone Oaks, the La Canteras, the Pearl District, all of those areas, they're already saturated with folks. Right. So there's no deals to be had there. So if nobody's moving out of their house because they essentially have to downgrade, they're either going to downgrade the house or downgrade the mortgage, in some cases both. Why would they do that unless they're absolutely in a pinch to get rid of their home? And then you got a bunch of companies like JP Morgan that are buying up a bunch of real estate and turning into the world's largest landlords. I feel like they're essentially bulldozing people out of the American dream, and they're going to turn a lot of us into renters, into serial renters, into lifelong renters. And that is like the number one way, the surefire way that people stumble upon wealth in this country. It's just by living in your fucking nest egg for 30 years.
Yeah, I'm
paying it off for 30 years. Yeah. Go ahead, Stephen.
So nobody is leaving a 3% or 3.5% mortgage.
They have to be stupid.
Unless they have to relocate for work.
Right.
Yep.
Or if they're retiring and decide to move to a different state. Yep. or if they need to downsize because they're in a pinch. People who want to move are staying in a 3.5% mortgage, because why take on a new mortgage at 7% if you don't have to? It
Right.
doesn't make any sense. The other thing that TJ hit on is very real, and it's not just JP Morgan. You look at BlackRock. I've read several things. I don't know if they're true, that BlackRock is the single largest homeowner in America now. Could be true. I don't know. I've read on the internet, but there's a lot of REITs that are looking at single family, multifamily homes. I mean, at some point, what we are doing in this country is not going to work anymore, because it's working for less and less people. And the only way that you can fix that is in the free markets. But there needs to be some protections, because TJ went and is closing on another house. He doesn't know if he's bidding against BlackRock. Like that is a problem.
Yep.
I am a pure capitalist. The only thing that I feel like there should be some protection on the consumer side on is homes. For the simple fact that an individual buyer has no chance at competing against a financial institution for a single family home. And it's ridiculous that they would even have to. It's going to hurt this country more than it does good. And I like to invest in REITs. I'm happy investing in commercial real estate REITs. I don't want to be invested in single family REITs.
So you wouldn't buy American Homes for Rent, the stock, or you wouldn't buy some of these other real estate investment trusts that are specifically focused towards
Look,
single
I'm,
family.
I'm invested in Altria, so I'm really not one to talk about morals, but it's more a principle thing. When it comes to Altria, I believe that all adults have the
Yeah,
freedom to choose,
good choice.
because tobacco is legal. So you want to do it, that's fine. But when it comes to homes, there's just, I don't know, there is a fundamental flaw in an individual bidding against BlackRock or JP Morgan,
Yeah.
especially
Well,
when they're making the money, loaning you the money for the mortgage.
yeah. Well, I will say specifically. I mean, I've uh, not devaluing anything that you guys have said, but I kind of want to go back to what TJ was saying with respect to they wanted his kidneys, they wanted what his blood type was and stuff like that. I closed on 2 properties within a year of each other. One was an investment property, and more recently in October I closed on my first personal residence. And so the I would say the second one went smoother because I had worked with those folks before and they kind of already had a lot of my details from the first one. But
Yeah.
that being said, they still were like, we need to know what your 401k policy is on, being able to withdraw. And like, I'm like, what the hell? I'm like, I didn't need to give this for my investment property. Like, why am I having to? They're like wondering if I default or like anything like that, if I'm going to be able to pull from my 401k, because they want to be able to know if they can go after that money in case, or I can go after that money to make sure that when they're underwriting this home, that they're not going to have to eat crap, because in case home prices go down or anything like that. Because I think I only put a 10% down payment. I mean, I could have put down 15, but I was like, it just doesn't make sense for me. I'd rather just pay a slightly, I think it was like $150 more a month, where it shaved $150 off a month by going to 15. I was like, I'm not going to put down an extra, what was it, like 20 grand to be able to pay this extra 5%. Just didn't make any sense. So I was like, let me just keep that 20 grand, keep it in the market, and I'll be able to make that extra $150 a month. It'll be fine in the long term. But anyway, it was just interesting to see some of the more intricacies that they were having about rerunning credit and stuff like that. Um, it was very interesting. I was just very surprised that they wanted to know how my 401k works, just in case, and that kind of scared me a little bit. It made me took me by surprise
Right.
that they wanted to know that, and I was like, you weren't asking this a year ago. Why are you asking now? So it was a little bit scary.
Yeah, things are much tighter. Bankruptcies are going up, unemployment's going up. So it makes complete sense that these questions would be asked.
I think my issue, and I think Steve might have spoken on this before. I heard, because I'm never smart enough to come up with shit on my own, guys. We all just copy from each other. But like this whole thing about everybody, like this Fed being so enamored with this 2% deal. Like, why can't 2.5% be the new norm, and a lot of this shit would just go away? I'm just saying, like, I feel like we get fixated on this denominator, and I'm like, and it literally will cause millions of people to not be able to live today the way that they were living yesterday, just over some fucking number that in my mind seems pretty arbitrary at the end of the day. Maybe I'm totally off base though.
No,
and
you're not.
You're not. You're not. I mean, I think
that's
the part. That's the part in July where I think we had that big retracement, because I think things were kind of going back to the normal. The market was starting to run a bit in July timeframe, and then they were coming out being like 2.0 means 2.0. And that's when you had this big retracement in the second half of the year to now we're kind of getting back to that same place we were in July when you look with respect to the S&P and the NASDAQ 100. But I think that was the big piece where people were like, I don't know, we're not out of the woods yet. And it wasn't really until October when they started reposturing themselves again, where I think people started feeling comfortable putting money back to work.
Yeah, TJ, if memory serves me correctly, I believe I said something along the lines of the Fed has done a pretty good job at threading the needle between their dual mandate with keeping maximum employment and prices stabilized. Now, at some point, they're going to have to choose between one or the other, because at this rate, they're going to have to break something to get the win on price stability down to 2%. And I would personally rather pay $103 for something that's $100 for more Americans to have jobs. Like I've always had that mindset, but it goes well past the Fed. And we need, and this is good, I'm not going to get political, I'm going to get more free marketing because I'm much more of a libertarian, but we need much better business acumen in this country, because the only way that you're going to forget inflation back to 2%, the only way you're going to get prices lower is if you have a better business environment. And look at TVs. Back in the 90s and early 2000s, how much were 50-inch plasmas?
And 10 grand. Oh, 10 grand.
5 grand. Yeah. 6 grand. You guys remember that?
Yeah.
Today, you can get a freaking 75-inch great smart TV for $1,000, $1,200. That's going to last you 6-8 years from Samsung. So you can't tell me that innovation does not drive prices lower. You need to have a better business environment that allows better competition, take the reins off energy. When you take the reins off energy, you bring the price of oil and gas down. Those are the main inputs of many things. They're certainly the main inputs of fertilizer. You bring the cost of fertilizer down and oil and gas. Farmers are going to have a better time. They're going to be able to charge less for their products and still make their spread. Transportation costs go down, and overall good prices will go down. But in order to get there, we also need to figure out taxes, because the tax situation in this country is crazy. Yeah. Absolutely crazy. And we need zero-based budgeting. Like we need to really look at a lot of things, and you can't tell me that we take in the amount of money that we take in and we can't make it work and make an environment where businesses can thrive. And how does the cost of goods go down? It's through competition. It's no other way. That's why they have anti-monopoly laws, because of competition.
Well, go ahead. Well, I was just gonna say, I just want to take a moderator moment. I know it's past 12:15 here, 11:15 Central. We've been going for about an hour and 48 minutes. So I want to make sure, Steve, do you want to go into ET, or would you rather come back a second day?
Do it another night.
Okay. TJ, I had to cut you off. Let's rally it up. within the next, I guess, 5-10 minutes.
Well,
And
it won't
then,
take long. I wanted to play a game that I started playing on Power Hour, and it does pretty well. Do you mind if I
Okay.
share the screen real quick?
Yeah, sure.
So here's my Robinhood wheel tracker. I don't know if you guys can see it. Okay, super. Is that big enough? So I want to draw y'all's attention to 17, row 17. So this is going to be the shares. This is going to be the amount of shares and what it's currently going at. So I'm going to go to row 22, and I want to play a game called overvalued, fairly valued, or undervalued. So I'm gonna start with Amazon. Amazon's currently at 143. Is it overvalued, fairly valued, equal valued? I don't need a soliloquy. I just need an answer.
oh, let's do
There's
it.
a reason I'm asking these questions, and I'll tell you at the end.
It's one of the hardest stocks to evaluate, TJ.
I know, but I just need an answer.
I think it's fairly valued here.
I mean, look, I think it's going higher, so that would mean it's undervalued,
I do too.
even though the metrics wouldn't support that.
All right. What
But
about
that said, it can go up 10-15% a year, but so will the growth rate, right?
So end phase is at 98.32. Overvalued, fairly valued, or undervalued?
I think overvalued for right now.
I think they're going to have a difficult time until rates come down. So I'd say neutral on it. I don't know. I don't follow it enough.
What about Google? Google is currently at
Undervalued.
137.
There's
Over.
no question in my mind. That's so undervalued. It's crazy.
Undervalued.
Agreed.
I think the PE could go up another 5x. Not 5x from here, but from 22 to 23, where it is today, to high 20s.
So Palantir, 1980. Overvalued, fairly valued, fairly
I think
valued.
overvalued for right now.
No comment.
PayPal. It is at 55.40 according to this spreadsheet.
Undervalued.
Fairly valued.
I don't think y'all know enough about right. I'm gonna leave that one alone. What about SoFi at 670?
Undervalued.
Undervalued based off of what I recognized when I was talking to Tanner on Sunday with the mega stream that we had with all 6 of us, with Jeremy and the finance junkies.
Yeah, he did not do a good job.
Who did not? Tanner?
Nope.
I think he's kind of become not a bearish overall, but slightly more bearish on the company in the short term, just based off of maybe what he's hearing. But just from what I'm looking at, a price to EBITDA of 15, 16, and the pace at which they're growing the EBITDA, I think that it's definitely cheaply valued. I have spreads for 2026.
And then the last one is Tesla. It's currently at 241. Over, fairly, or
overvalued.
Over.
So
but
now
that said, I've always lost money not investing in Tesla in terms of opportunity costs.
So now I'm going to narrow it down because I'm trying to add to these positions. If you guys look at row 17, you're going to see the amount of shares on certain stocks, right? 1,200 on Amazon, 11,000 on Enphase. I didn't want to have 11,000. I got shares put on me, so I'm working with what I got. I only got
you're adding to these to sell options on. You're not just adding to them as an investment, correct?
Correct. But this is where I'm at. This is where the eagle landed, right? I have 1,200 shares of Amazon that I'm really excited about. And I bought these outright. I didn't get these assigned, dude. I just like, hey, at some point I got to get involved in companies that are making money. And I don't care about the valuation right now because I feel like it's going up and to the right. And that was Amazon. And I bought the shares, selling covered calls against them. It's working out. And then Enphase, I got a bunch of shares put on me at 139 average. I've got an adjusted cost basis of 125. I'm going to turn that position eventually when I get to even. It'll have like 5,000 shares. That's the max that I want on Enphase. But Google is one that I have a hard time with because I invested in the IPO and it just bothers me. Nothing to do with Google. It just bothers me that I turned 16,000 into 80 that could have been worth like 800,000. But that being said, I got 1,000 shares at a cost basis of 127. adjusted cost basis of 125. So I'm contemplating doubling the position on Google or doubling the position on PayPal. I could theoretically do both. I have enough monies available to do both. But if you could only do one, y'all want to spend 30 seconds on that question. If you can only do one at these prices, I feel like in my mind, the no-brainer is PayPal, but then it goes against a lot of the things that I said on Verizon because it's a turnaround story, etc. Even though I feel like it's overvalued or undervalued, Mr. Market's telling me that it isn't, and it's not growing at the rate that Google's growing. Google's a fucking cash printing machine. Forget about the fact that I feel like PayPal could manufacture the double because they'll just buy back the float. Google will double because it's Google. Which one? If you could only just pick one, is it Google, PayPal, and just give me a 1 or 2 sentence on why?
Yeah. So the way that I would respond to that, I'm a shareholder of all three.
Yeah, because I'm just saying it's not as cut and dry.
No, it's not. So, and this is just me. This is nobody else. But if I was going to put more money to work in one of these three, it would be Google, because I think that it has the best chance of appreciating at the moment based on everything that I have read through the financials. That being said, knowing what you are using these for, I looked at Google versus Amazon on Monday or Friday for writing contracts on. And the premium was significantly more enticing on Amazon than Google from that perspective.
For sure it is.
So
I feel like Google makes money, bro, whereas Amazon, it's like it makes money, but it doesn't make Google money.
yeah, I mean, for me, Google would be the one I would allocate capital from to, just on a what do I think is the safer play. But that's just me.
What about you, Matt? Because I know that you understand valuations at a higher level than I do.
I mean, I guess my question is are you looking for share price appreciation or are you looking for theta decay?
The loaf is in the capital appreciation. The selling puts and selling calls and collecting premiums, guys, those are crumbs. That's my cash flow that keeps me in business. But the big money is always going to be made on buying something for $1 and selling it for 2 or 3 down the road.
I think let me ask another clarification question. Actually, there's many questions I would ask now that I have you on the horn, but specific towards your question, are you looking for a year out, 2 years out, or 5
No,
years out?
this is 2025 minimum, more like 2030.
2030. I would say the most guaranteed one in terms of return would likely be Google. I'm afraid of the PayPal turnaround story. I think that if PayPal does go up, it's probably going to be more likely due to share buybacks and at the pace at which it does go. But not everyone pulls in and gets rid of a Steve Ballmer and pulls in a Satya Nadella and does a Microsoft, right? And so, I mean, I was there in 2015 having 50 odd shares of Microsoft, and I wish I had held on to them because Satya Nadella just came in, and I was just like, I don't know if I want to be in this company as of right now, and yada yada yada. So, that I guess it just all depends on what you think PayPal really is going to do long term. But I can guarantee with more certainty Google will do better. I personally wouldn't undervalue Amazon because within a couple years time we're going to be at $1 trillion in sales on Amazon. And it doesn't take much for Amazon to say, okay, $1 trillion is that point where we're going to start to want to get our 2% margin, not a negative 2% margin like they've been going to. And they go to the Walmart model and say, all we need is volume and 2% margin. And next thing you know, they're printing cash along with AWS. Right. So I think that there's that possibility as well. But for right now, with what we know, I would say Google is probably the easiest one.
So then the last one and the hardest question, and I'll let you guys go with this. I've been trying to get Palantir to 25,000 shares since I started. That was the mission in this portfolio. And I got stuck at 15 because all of a sudden I started rereading The Intelligent Investor, which is a freaking mistake when you're dealing with growth because it's just not, you're not going to buy anything. I'm going to be like the Everything Money channel. Look at everything, won't buy nothing. And Palantir's valuation just stopped making sense to me. Whereas before, I was just like, I had money, I'd scoop up the shares, and I got stuck, and I wasn't able to buy the shares that I wanted to buy, and I feel like I'm just under invested in a company that I truly believe is a once in a generation type company that will definitely see $100 billion market cap with an outside chance of a $1 trillion market cap by 2030, 2035. And I'm sitting here with a decent position, but it's not life-changing money for me. So when do I add the 10,000 shares, bro? Like, do I just say fuck it? And I know it's going to go to a quarter billion at least, or a quarter trillion, or do I just stay strong? Because there's a little gap potentially at 14 or 15, but more than likely that's not going to happen, I feel, because the story just keeps getting better and better and better. Every time I watch a Myths channel or Palantir Weekly, all y'all have to do is say good things about Palantir. So it makes it very, very difficult to sit on the sidelines with this money available and not just top off the position, if you will. Because it's a hard one on evaluation. I think we can all agree on a short term, the metrics don't support the price. But on the long term, if they keep growing and hitting their multiples and they have a beautiful balance sheet, I think it's grade A, in my opinion. I mean, shit, man. Sometimes you have to overpay for a good thing because it's just that good.
I think that everything money guys get a bad rap for no reason.
Yeah, I think it's great. It's just not
good.
my
I like them.
I mean,
they trade differently than I do. I can't blame them for that.
Yeah, the thing that people need to really remember is Paul has money, and he sticks to a process that works for him, and he doesn't need to generate a 10x. That's not his investing style, and it works for him, and he has a lot of good logic about a lot of things. And I think that they get a bad rap from a lot of people, and they've probably done better than a lot of people because a lot of people take outsized chances that don't necessarily pay off. As far as your question, I think that's something only you can answer, TJ. I mean, like I said before, there's nothing guaranteed. I mean, I'm invested in Palantir and I don't move in and out of it because that's just not my.
What I'm saying, when you're adding to a position, though, do you go through the entire investment thesis, or do you just kind of like DCA into it until you get your position there? Because I
DCA into it. Sometimes I DCA up, sometimes I DCA down. I mean, I bought Palantir at 9 when it first direct listed, and I think I've paid as high as 23 a share for it. I paid all over the map. Like SL Green, something I don't talk about a lot, but I started a position last year, roughly a year ago. I have made, I'll tell you exactly how many purchases of this fucking company. 30 purchases in the past year.
Of Palantir. See, I'm showing my purchases there. I bought 5,000 shares at 9, and then I did the hardest thing for me, which is averaging up. And I picked up 5,000 shares at 14.26 and 5,000 shares at 14.70. And it was totally out of my comfort zone. And from a price perspective, it's totally worked out as of now because it's at about $20.
Yeah, the thing with Palantir is I wouldn't be surprised if it goes to 14. I wouldn't be surprised if it goes to 28. I mean, nothing would surprise me. And I'm holding it for several reasons. One, I love their methodology and I love what they stand for. I love that they want America to be the best in defense and everything else. I mean, I'm a patriot. I think it's going to be the most important software company behind Microsoft by 2030. But at the same time, my investment thesis could be wrong. So I don't know.
Right.
I think it's all about risk tolerance in that respect. And, PayPal I don't think, to see the true value of PayPal, I think that if that does turn around, it'll be way before 2030. And so
the question with PayPal is if it's such a good value, like we think, or like I think it's a tremendous value. That's why I allocated more money than I really wanted to into it. Because I bought myself out of a hole, so to speak. Not really, but I dollar cost average down. But my thing is, why has nobody acquired them? Like that's the thing that's bothering me. This is a company that prints cash. Market cap is next to nothing. They have like 90% of their debt in cash on the balance sheet. They're generating $5 billion annually in free cash flow. And it's not a dead company. Dead companies don't grow. This company still grows revenue quarter over quarter. So why are they not being acquired at these prices? It doesn't make sense.
Or it might just not be the environment for mergers and acquisitions right now with the uncertainty of a potentially looming recession and things like that. I mean, people might be playing a little close to the vest. I don't know, because I mean, to me, it seems like a target for one of the Magnificent Seven specifically comes to mind. Like I think of Google Pay, I think Apple Pay.
Yeah,
You know?
Apple, Google,
they got money in spades, right? So
they could pay cash for it. You got
yeah.
Visa, you got MasterCard, you got Amex. I mean, they could certainly do it, or even one of the big banks, Bank of America, Wells. I mean, there's a lot of different companies that this would be an interesting fit for, but yet there's been no chatter about anybody acquiring them. I mean, fucking, what's their market cap? 60 billion now?
I
Yeah,
believe
50 to 60.
I mean, think about 60 billion. That is not a crazy acquisition price.
It's not. I don't know. I mean, to me, it's all about, can you beat the S&P 500 with lower risk or slightly higher risk that benefits that reward, right? Or makes that reward worth it. And so to me, you know, Google I can see continuing to expand and trim, and I think they're getting more prudent about their cost spending because they were getting a little bit out of control
right.
after the pandemic, and they needed to, right? Revenues were expanding so aggressively. I mean, you can't grow at a fast pace and be efficient at the same time, right? You know, you kind of get one or the other. I mean, you can be a little bit more cost conscious, but the more cost conscious you are, the less you're growing. So it's a kind of a catch-22 in that respect. I don't know. I mean, the thing with Palantir, as much as I love it, you know, I wish I had a bigger position. The thing that I can't get over is my base case for the company is probably 150 to 200 billion dollars. I think that it could be as low as 120 to 200 billion. So I think eventually it'll get there. I just think that it's still too early to say, will it truly get to $1 trillion valuation? I've used the software. I use it every day. I love it. It's completely transformed the company I work for in terms of bringing us to the 21st century in terms of how we store and utilize data. I completely understand when they say the same thing about many other companies that get up on stage and say the same. But to me, the numbers haven't caught up yet. And I'm trying to understand why the numbers haven't caught up yet. Is it because they want to get as many kind of big customers through the door to transition, and then they turn on the switch where they say, okay, now we can charge you $2 million instead of $1 million per engineer that we have hosted with you guys? Or is it a point where they start to get net dollar retention up? I'm still just trying to understand, but if that was the case, I feel like client growth would be even faster than it is. But maybe that's based off of what we're going to be seeing, hopefully, with this new rollout of AIP and stuff of the like. But for now, it's like if my base case is 120 to 200 billion dollars, shit, that's like a 3x to a 5x from here.
Right.
And you know, there could be other opportunities out there that are 10 to 20 x's that, you know, like I think Rocket Lab could be eventually, you know, more likely is a 5 to 10x than say a Palantir, and the risk is getting better and better by the day, from a lowering the risk, I mean, on a Rocket Lab. So it just goes to check whether or not you're interested in that. But to answer your question, I mean, I think like what Steve said, it could be an opportunity where if things flounder a little bit with Palantir, it could go back to $14, you know, rather easily.
Right.
Now that, you know, all this pent up demand about NHS is down, you know, it could travel to the $17-16, and your cost basis is around there, isn't it? Isn't it like 15, 16?
Well, mine's 1265 in that portfolio.
Okay.
Yeah.
In that portfolio, got it.
Yeah. And then I got 3,000 shares in my wife's that are like at 858. 3,000 shares. But again, I've never been able to load the boat, and it was there. I had money when it was at 6 and 7, and I would just, 200 or 300 shares here. I just wasn't committed, and I don't understand why, because I believed as much then as I do now, but I just could not pull the trigger, and it bothers me, bro. Like, it's the one stock that I'm thankful that it's in my portfolio because it's performed extremely well, but I just feel like it's like when I'm still building the Tesla position because I'm stuck on valuation with Tesla. Like, I'm waiting for that miracle $106 again, right? It was not going to happen, but I'll take 150, and I'm still trying to build out positions. But once I get a valuation in my head, dude, that is one thing. Like, I get in early, but once I establish a position, I'm not in a hurry to like continue loading the boat because I feel like the market's going to give me my price, or I'll just go find something else. And that's why I have my 8 stocks. And I'm like, whichever one gives it to me first, that's where I'll put the money. And I'm thankful that I finally just threw my arms up and said, screw it, I need Amazon and Google in the portfolio, because these guys, I mean, they're part of the Magnificent Seven for a reason.
Yeah, and I mean, I do want to just say, I mean, if we were, I fully see in 2 to 3 years, Palantir having a strict budget where they're going to be buying back some shares. They're not ones that they're not in a very capital intensive business, right? So they're going to be in the same boat of a Google and Amazon where they have so much. Maybe not Amazon. Amazon's probably a bad one to kind of discuss because they do have kind of capital intensive pieces of their business, but Google being a high net margin business, they are going to have a lot of capital sitting on the sideline where they're going to end up doing buybacks. I just think it's too premature for Palantir to go ahead and do that. But I think 3 years from now, Palantir will be completely offsetting a lot of their share-based compensation. And when that happens and the share float starts to decrease, I think it's going to be a completely different conversation that you and I are having. But unfortunately, I can't make that kind of assumption, right? I can assume, but it's literally just going to make an ass of me because I'm going to be wrong. What I can guarantee is that revenues are likely to continue to increase. The things that I think are continuing to be positive, and I think for now, I would stick with Google for right now. But I think in 3 to 5 years, we're going to be sitting here being like, Palantir was the better decision. We had this conversation November 22nd, 2023, but we were too big of pussies to say, you know what, TJ, go full port into a Palantir. But I fully anticipate that eventually they're going to buy back a crap ton of shares at Palantir, and we're going to be sitting there laughing our asses to the moon because, the more shares that they buy back is just going to be better and better for us. But I do have one last question for you. Why don't you do many ETFs?
I actually have an ETF portfolio that I don't show, and I wheel the Qs and I wheel the SPY. It's extremely boring, but it pays money and it's very low stress.
How can you say it's boring? They have daily options.
Well, but I'm saying it's boring from the standpoint that you're not gonna 10x anything, but you're gonna sleep well at night, and it's great because there's like liquidity among us. It takes a lot of capital though, man. I mean, it takes a lot of capital to wheel the Qs and the SPYs, and that's why, like, I mean, everybody's like, oh my god, you do the marathon and ride. I'm like, dude, I've made $750,000 off of those 2 companies. But I stick with them and I go real heavy and I do it for a long period of time. And it's like I'm stubborn with my strategy. Dude. When I find a stock, I'm like, okay, I'm going to own these shares with other people's money. That's the ultimate goal. So I'm going to sell put, sell call, select premium, bring enough premiums through the door so that I can look at my basket of premiums and be like, okay, that is more than what I pay for these shares. Thanks, Mr. Market. You just bought these shares for me. And everybody's like, why do you have so many shares of SoFi? And I'm like, because half of those shares I own with your money, with Mr. Market's money. And I'd like to own another 500,000 shares with Mr. Market's money if he'll give them to me. That's what I was going to ask you, Steve. When's the golden parachute for Nodo? Because I am going to get rid of half of my shares on the day that happens. Is it $20? Is it $25? Because he's got
25, 35, and 45, I think. Or the different metrics he needs to hit on the RSUs. I don't remember the date.
I'm
Yeah.
sure it's in the 10Q maybe, but I just wanted to give a quick shout out to Man on Mars. Thank you
Wow.
for the tenor, my friend. Much appreciated. And if you guys are interested in becoming a member of the Matt Money channel, there is right when you do the super chat, there is a membership button, and I think it's like $2.99 a month or something like that. It would be really cool if any of you guys are interested in doing that and showing a consistent membership to the channel. And I
Shout
look
out
forward
to
to doing
Bill
it.
White in the chat, dude. He's been hounding me about Palantir for a fucking month.
The free cash flow will be insane. And one thing I know that I got really heated with Arnie the last week on Palantir Weekly about his $18
Well,
fair
you
value.
just didn't want to hear the pie in the sky thing, is what you
I
wanted.
didn't. Yeah, it's already going to be fugazi enough talking about it, and assuming 30% annualized growth for the next 12 years just didn't make me feel. I just couldn't sit there and say, sure, right, whatever you say. I just didn't make me feel right. But I'm just looking at Palantir today. We're going to make 550 million in cash flow, not from just operations, because it is going to be 160 or so from interest income as well. But next year, you're looking at, if they're able to achieve a decent revenue increase, and now that you kind of have this NHS deal, it kind of helps a little bit with that as well. But I anticipate you're going to be making closer to 750 in terms of cash flow next year. Or just kind of coming into the business, 180 million of which is probably going to be from interest, but the rest, 500, 600 million is going to be from operations. And I wouldn't be surprised to get close to north to 900 million in fiscal year 2025, and getting closer to a 3.2 to 3.5 billion-dollar run rate in terms of revenue. And if you start just thinking about having a 25% cash flow margin, like Steve always talks about, this thing, when it starts getting up there, I mean, in fiscal year 2026, you're going to be having north of $1 billion of cash just being added to the balance sheet every year. What the hell are you going to do with all this?
Yeah, I mean, the
You know what I
thing
mean?
I didn't really like, and I think he does really good research, but
He
you
does.
can't,
Arnie's one of the best when it comes to
like,
research.
I'll never take anything away from the guy. He does great research, but you can't just show an Excel sheet and say 30% growth year over year for 10 years. Like, no company stays stagnant.
Right.
And you need to be realistic with that. And the reason I always go back to a 25% free cash flow margin is because there's been 2 quarters where they had over 30%. I think one was like 34 and one was a 33 point something percent free cash flow margin. They've had several quarters where they were over 20%. And in the future, when they are getting more efficient, there's no reason why they can't generate a 25% free cash flow. And when I look at their current growth and I look at a quarter over quarter growth rate that I think makes sense, I can see them getting to a place where I think the market will value them, where it is a multiple X on my money. And, that's the way I look at it. Everybody looks at things differently, but picking a static number is just, it's crazy.
Yeah.
But
Well,
I got to get going though.
I gotta get rocking and rolling,
I
man.
didn't realize it was 12:45.
I just want to give you all one last shout out, man. When I started this journey, I would wheel a lot of shitty companies, bro. And I made a lot of money. I got lucky doing it. But then I stumbled upon, the Palantirs of the world, the Teslas. I mean, I was already messing with Tesla. I've been messing with Tesla for going on 10 years now. But when I realized that I wouldn't make as much money wheeling profitable companies, but I would sleep better at night, and preservation of capital became a key component of my strategy. I feel like I learned that by watching people like you guys versus
TJ,
like,
I've always had a question for you.
I'm going to be the Kathy Wood and just wheel a bunch of shit and make a lot of money.
Have you ever thought about a monthly dividend paying company and wheeling it to collect the monthly dividend
Yeah, the
in,
Christmas tree.
in addition to the option premium every month?
Definitely. There's a couple of companies that I'm jacking with a little bit. One of them has really gotten his ass kicked here recently. I don't know if it's a monthly, but it might be a quarterly. It's called O. The
Yeah,
I'm a shareholder in Realty Income.
yeah. The
my
options premium is tough though. The liquidity on that stock would make it tough to write options.
Yeah,
I've heard
there.
that.
Then the other one that I had for a hot minute in my portfolio, but I just again, it's another turnaround story. I'm a sucker for these turnaround stories, and I don't know why, guys, because they don't play out very often. Like statistically, they don't play out very often in our favor. Not every company is going to be Booking.com, right? Like I remember the reverse split, just shit went to the fucking moon. That's a once in a lifetime type of a company. But Walgreens was one that I had in my portfolio for a little bit, in my wife's portfolio, a couple hundred shares. And I was just like, dude, I don't know that I want to be part of this turnaround story because, first of all, the new CEO is going to come in and this dividend may go away because they got a lot of shit to fix. And so that one was out. Intel was one that I've wheeled for a couple of years now, but they've slashed the divvy here recently,
Yeah,
and
but the company's up what 30%
I
in the
think it's
past
like
year.
$45 right now. I was wheeling it in the low 30s, and I made money. I made a few $1,000s off of Intel, but I always just believed that AMD and Nvidia were the class of that whole industry, and I
So
and I just
I'm gonna leave you with this because you just said the three letters I hate. Um, I used to swing trade
Mhm.
AMD. I used to make some good money doing it, and I got stuck. And this is before this had to have been 10 years ago.
before Lisa Sue or whatever the name of the CEO.
Oh, yeah, pre-Lisa, so 10 or
Mhm.
11 years ago, before options were even really a thing or anything like that. And I ended up getting stuck. Okay. And I tried buying my way out of a hole. This is when it was the $5 to $7 range. Like I would buy it like 5.50, sell it 7, wait for it to come back down, buy again, blah, blah, blah. End up going down to like 275, and then it went down to 199, and I doubled down at like 205. I had 7,700 shares of it.
Nice.
And I said to myself, I just want my money back. Once I get my money back, I'm fucking getting out. Like I was stuck for years. Like if you go and you look at a long-term chart, there is was I was stuck for at least a year and a half, 2 years.
What Steven's
Um,
saying is he wouldn't be hanging out with us if
hold
you
on.
didn't sell early.
I will never forget it. I'm driving down on the New Jersey Turnpike to Atlantic City. This is how much of it, how bad I was. It was moving, right? I'm watching it while I'm driving on the Jersey Turnpike like a moron. And it shot up to like my break even. And I fucking pulled over at the next rest stop and sold it.
Hmm.
Fucking sold it. Next thing I know, it never came back down. Now, I
Steven wouldn't be
certainly
talking
would not
about it.
have held it to where the fuck it went to, but I probably would have held it to like $12. Like I'm not saying I would have been smart enough to hold it to 120, but that's the one that got away.
Well, I bought 16 my whole that's all I had in 2004 when Google went public. I bought $16,000 worth, and it was time to buy a home. I was recently married at the time, and I sold my shares for $80,000, and I thought I had won the lotto. And one of the fucking nerds on my channel was like, "You'd have 816,000." I've never blocked anybody from my channel, but I thought about blocking him just for pointing it out.
Would you have like I know myself? I would have never rode AMD. I find it harder to ride winners up than to DCA into a position for some
I don't
reason.
know what's wrong. We're degenerates, bro. I do it all the time too.
Like you really think about that. If your cost basis is 368 on a stock, like 368, what the hell are the chances you're holding it to 120?
Yeah.
Unless it just goes up in a straight line in 2 weeks. Like, what are the chances you're holding it for 5 years? I mean, it's
Unless you're
That's
writing some decent covered call
I'm
income,
saying that's
right?
why
I
I
mean,
started selling covered calls because I needed that static income because I had no idea how to pick an entry point and definitely not an exit point. I mean, an entry point's a little bit easier to pick than an exit point. So I'm like, let me just sell these covered calls. And then once I realized that I could roll these covered calls, I'm like, shit, you're telling me I don't really have to like commit, but I can bring some money through the door. I was like, dude, cheat code. I'm ready to be a multimillionaire. And that's how
Yeah, I may have to.
But I
Actually, Palantir went down, so I may not have to roll anything. I wrote options on Palantir the other day, and
bro, I have options at $12 for January 2025. Those are fucked. I'll have to roll those for like the next 16 years. And then I have options at 17 for January 2025. I'm not stressed on those. And then I've got options at 18 for January. So I'll be rolling Palantir options for the next 5 to 7 years. And I'm okay with it because I just get one big fat, I don't have to mess with that trade. I just do it one time, call it good, increase my strike price $3, $4, $5, call it good. And
I'm curious why you sold that long of a contract though.
It's because I got in trouble. I got in trouble on the covered call. And instead of just taking my medicine and buying to close, I was like, no, I want to roll for a credit. And then I just kicked the can down the road. And I also thought this is again where you got to admit when you're wrong. I thought Palantir was overvalued at $12 when I was doing it. So I was like, well, this shit's going to come back to me. And then Mr. Market just like, no, it's not going to come back to you anytime soon. So now I've just accepted defeat as far as my valuation metrics and all these fancy intrinsic value calculation bullshit models that I have access to via the hedge fund. And I'm like, okay, Palantir is the new Tesla. It's the one stock that I'm going to be part of. I'm thankful, but the valuation is never really going to make any sense. Forget about that. How do we make money? You know, and that's what Palantir is to me now, guys.
I just went out a month on them. I got 17 cents a share on the December 15th chain at a 25 strike. Because I was like, you know what? I really don't want to have to roll. I would like them just to expire.
What was it again, Steve?
So it's the December 15th chain.
Okay, a couple weeks away.
25 strike. And I got 17 cents a share.
You're golden, 25 strike. I don't think Palantir.
Yeah, and that's what I said. I'm like, you know what? I could have done 23, but when I wrote them, Palantir was like 2050. So I wrote them on Monday, and I'm like, you know what? At 25, that gave me I needed Palantir to go up like 20% or 19% to have them called away. And I'm like, if they get to within a couple of percent, I'll just roll them.
Yeah.
Like TJ, at that point, let's just say Palantir got to 24. Mm-hmm. At what percentage point do you decide to roll? Do you have like a percentage that you pick?
Yeah. So if I'm under my strike price, you don't have to roll on a covered call.
No, I get that.
I'll buy to close at like 90% just to take the risk off the table. But whenever I roll, like I don't know if I can pull. I know we've been on here for a while.
I don't have anything to do.
I don't have shit to do. That's the thing. Like my wife is literally sound asleep, guys.
So I need to get sound asleep. I got to drive into the city in the morning.
But I was just trying to give you like a legit example here. Is it?
You definitely write way closer to the money than I do, though.
Well, it's because I'm trying to legit bring money through the door, right?
First, yeah, I mean that's where you get the premiums.
Yeah. So for instance, like I can look at an example here. Let's say PayPal expires this Friday at $55. So it is currently. Oh, this is a put. I'm sorry. This is cash secured put. So I'm golden here. Let me find a covered call where I'm underwater. Because trust me, I'm sure there's one. Here's one that's interesting. I have Enphase at 102 expiring on December the 1st. So right now I'm underwater because Enphase had like that 20% jump in a day, but it's still way below my strike price. So what I do is I go to
what day is this for?
12/1.
Next week, next Friday.
12/1. So what I do is I just go to simulate my returns. And I'm like, okay, if Enphase just stays where it's at, when am I going to break even on this? And that's going to happen November the 26th. So this coming Friday, guys. And I think Thanksgiving's off and it's only half a day on Friday. So I have all of that free theta decay in my favor. So as long as Enphase doesn't go real crazy. But when do I roll? A covered call is when I no longer, when I'm above my break even point specifically. That's when I like to roll. So I look at what premium I brought in and it was 93 cents. So my break even's 102.93. So the minute Enphase breaches 102.93, that's when I really look to roll. But then there's also calculations here called intrinsic value versus extrinsic value. So the intrinsic value is like, let's say this was already in the money. Let's say this was 103. I would subtract the 103 from the 102. That's my intrinsic value. And then the rest of it is going to be the extrinsic value. I take that coefficient and subtract it from the dollar price of the option. And whenever I have less than 10% of extrinsic value left, it is time to roll, because the counterparty can call those shares at any time. The one thing that you have, this is poker, right? So the one thing that you can't control is what the counterparty is going to do with their cards. You can't control what they're going to do with their shares. Like if they want,
but if the stock is under the strike price, there's virtually a 0% chance that counterparty is going to.
They would be doing you a favor.
Well, yeah,
they would be calling. They would pay you $102 a share.
Yes.
Which is not. I mean, that would be absolutely have to be stupid, right? And
so
that's
basically, if you're writing a covered call at 25 and it goes to 26, that's when you roll.
If I've collected less than $1 on the premium, I look at my break-even price. But you ever get in that bind, dude, just reach out to me, dude. Like that shit is like second nature to me.
I was just looking at it and I'm like, I'll just freaking roll it if I have to, and it's not a big deal.
Yeah, but
that's what I did. That's what I did on Palantir today. I saw, the NHS deal got announced and it was kind of going the other way, and I said, well, it's like I'm right on 24.
So do you guys watch Billions?
Yes, I just finished. Yeah, I love it, dude.
Okay. You know what Palantir is? Palantir is ice juice without the golden frog.
So here's one. Here's my Palantir covered call for January. So you'll see there that now I have an intrinsic value, right? Because the strike price is at 18 and it's currently at 1965. So I take the 18 from the 1965 and that gives me an intrinsic value of 165. And then I subtract the 165 from the 284, and that's like $1.20, give or take, and that's my extrinsic value. So when
is this option up? What's the expiration date?
January of 2024.
Okay, so that's somewhat close. Okay.
Yeah, so it's down the road, right? I mean, we're talking about 8 weeks or whatever.
Okay, hold on. TJ, did you get the reference that I made about ice juice and golden frog?
Yeah, I've watched.
And is that a funny reference?
A little bit, yeah.
See, man, I'm not crazy. Go watch the show.
These people don't know about Dollar Bill, bro, and all that.
They don't know about Dollar Bill.
I haven't watched Billions enough.
Get a little culture. And then there's the girl. Who's the girl with the short hair? Kate Dillon, the nerdy lady that just challenges Axe the whole way through.
Oh, Taylor?
Dude, bro, what a smart lady, though. I mean, just fucking makes me feel.
I told him it's Thanksgiving. Market's not going to be open. Watch the first episode of Billions.
You'll be hooked, bro. You'll be fucking hooked. Hooked. So here, guys, whenever I have less than like 25 cents, because my break even is $19.99, because I collected $1.99. So there's a couple things I can look at. Is Palantir going to go? If it goes over $19.99, then at some point now I'm leaving money on the table. But right now I wouldn't be leaving money on the table if these shares were to get called away from me prematurely. But then, dude, I always just roll. Like I literally look at Palantir as one annual trade, bro. So I would just click on, like, it's for January. I'll look, okay, like, what will you pay me to roll this damn shit? Like 6 months, because I don't want to mess with it. So I know that I have to satisfy $2.84. And I just go over here and I'm like, okay, I'm not trying to make any more premium. I just don't want to have a net debit. I want to have a net credit, and I want to increase my strike price. So my mission is to just go from 18 to like 21 or 22. So this one's the one that really appeals to me. I'd go here. I look at the delta, and that's a 52 delta still. There's a shitload of dance partners on the floor. So I can just go right there and I can pick up $90. There's no money there. But what's beautiful is now I qualify for an additional $4 of capital appreciation on those 500 shares. Yeah. And I just play that game over and over and over again. And people are like, you're not getting any premium. I'm like, well, motherfucker, neither are you. Palantir doesn't pay a dividend. So I at least got paid a little bit of money to participate in the games. And I will play that game for the next 3 to 5 to 10 years if I have to with Palantir until I get in a situation to where Palantir slows down, because they all slow down, bro. It's just a matter of time.
Yeah.
And if it runs away and I sell these shares at $40, I'll wipe my tears with the profits. No big deal.
Yeah, I feel like for me, the problem that I've always kind of run to, specifically when I trade so close to the money, is I end up getting in a situation here.
Guys, I gotta go. It's 1
You're the
a.m.
man. You're the man.
See you guys later. TJ, I'm gonna text you tomorrow.
Appreciate you, brother. Bye-bye.
Later, Matt. I'm gonna text you too.
Later, brother.
Later.
Yeah, we'll talk about ET sometime. The thing that I have a problem with personally is when I write too close to the money, I just feel like I'm letting way too much. I'm chasing pennies for the potential dollars. And so for
Right.
me, Palantir is a golden goose, and I don't want to get rid of my golden goose. I want my golden goose to lay eggs. And so for me, I'd much rather leave a little bit of potential profit on the table, sell it at a 5 delta, and guarantee that I keep my golden goose, and do that on a weekly basis, than sell at like a 30 delta or something like that, and eventually get to a point where it might get called away. I Maybe it's just about the experiences where I've had unfortunate timings of investing in something like a Square before it runs up, to 100, $120.
Right.
And I bought it at 10 or 12, and I said, well, let me sell a $20 covered call, and I doubled my money. I was king shit. Well, by the time it actually get called away, it was trading at like 80, $90.
Yeah, you left a
So,
lot of meat on the bone. Yeah.
yeah, and I didn't know what the heck was going on at the time. So maybe it's just my experience where I'm like, oh.
So on covered calls, I can definitely appreciate that anxiety. On cash secured puts, the closer you are to the money, the more premium you're bringing through the door, which is your built-in alpha from the beginning. Because the only thing you're qualified for on a cash secured put is the premium, right? Like you don't benefit from capital appreciation or anything like that.
Right.
So in the off chance that you're actually right, you studied the technicals, and first of all, you're like, hey, at 650, I'm okay owning SoFi in this example, and they're going to pay me, this is 50 contracts. So I tied up whatever that is, 30 grand or whatever it ends up being, right? And they paid me $700 to tie up the money for 8 days. This is the way I always ask. This is the way I ask the question to myself: is where can you tie up? It's $650, right? Times 50.
Yeah.
So where can you tie up $32,500 for 8 days and get paid $700 up front? A, that's one. B is they're paying you $700 just for agreeing to buy a stock that you're okay owning for the next 3 to 5 to 10 years at a price that you think is a pretty decent deal, because you said that you thought that it was undervalued at this stage. So if it's undervalued at 671, it surely should be undervalued at 650. And on top of that, if you're paying me money to do so, why wouldn't I do it? Because to me, it doesn't make any sense for me to pick up peanuts and agree to do this contract at $6. And now instead of $700, it's probably only going to pay me like $200 or $300. And I'm going to have to tie up the same capital. I'd rather do that. And then all of a sudden shit changes. They announce that they're not going to be GAAP profitable, whatever the case may be. I can always roll this position 30, 60, 90 days, lower my strike price from 650 to 610, pick up another grip of premium, reposition myself. So on cash secured puts, it doesn't make any sense to be conservative in my mind. On cover calls, that's different, because you don't want to step over dollars to pick up dimes, is what you're kind of saying earlier in the analogy.
Yeah, I'm okay writing at the money on a CSP.
Yeah.
So I've done that before, and even like with Palantir, shit, man, I was just thinking about this. So if I didn't do this stupid thing and write naked calls on GameStop, I had to sell like a lot of stuff. I wrote naked calls on GameStop like an idiot in 2021, and so instead I had a bunch of stuff that was printing at the time. I had a lot of long leaps on like oil companies and Palantir and stuff like that, and I sold a lot of it at a profit. And unfortunately, I had to basically kind of come back and anyway. So it's pretty sad. I was thinking about that today. I was like, man, if I still had some of those, 'cause I had like $10 leaps and stuff for 2024 and for Palantir and stuff like that. But
right.
But anyway, it just
Well,
makes me
man,
think. Like a
it's been a
CSP thing, I
pleasure.
don't
But
mind.
if you ever wanna get down to the nitty gritty on cash puts and cover calls, specifically rolling, because I think that there's a lot of basic wheelers out there, and I think they mean well. But if you don't truly understand the art of the roll and what it's intended for, I don't think that you should be selling cash secured puts or covered calls, because you're going to leave a lot of money on the table. You're going to get in a bind, and you're just going to have a bad experience on a strategy that is literally designed to make you money almost in any market conditions.
Yeah.
And but if you don't understand all the rules of engagement, I mean, you got to get educated first and foremost, you know. And I have a channel with 800 videos, as you know. You've covered cash secured puts. Steve does a really good job of covering cash secured puts and covered calls. But there's not a lot of There's not a lot of channels that cover rolling on a daily basis, and that is what I try to do on my channel, is let people know that, hey, if you're going to sell cash secured puts and covered calls, do yourself a favor and learn how to roll in and out of those positions, because market conditions are going to change. You're going to get more information. It's called an earnings report. It's something. It's a short report. It's an article on Yahoo. It's something. Tanner's going to put something out if it's SoFi. Use all of that information to your advantage so you can make the best decision given the new market conditions. Don't hold your feet to the fire on old information. You know what I mean? Like, why would you do that to yourself? If you have an opportunity to rewrite the contract, if you're buying a piece of real estate, somebody got shot in your neighborhood, aren't you going to go rework that deal, Matt? If it's a piece of real estate, because you're signing on for 30 years, right? But people don't want to use that latitude with cash secured puts and covered calls. I'm like, dude, every day we get new information on our companies. So use that to reposition yourself so that you can win once you're clear on your objective. Like my objective on that cash secured put on SoFi is I like to get paid to own those shares because I want to own those shares. But on my cover calls on Palantir, I was bluffing. I got caught bluffing. So now I got to go defend that covered call. But I'm clear and I'm honest with myself. I'm not lying to myself. You know what I mean? Like, I thought it wasn't going to go to 18, bro. That's why I put the cover call at 18. And Palantir's like, I got news for you. We're going to 25, you know? And now I'm got to defend those shares because, one, I don't want the tax implication. And two, I just don't want to lose those shares when I feel like it could potentially be a $250 billion company, if not more.
Yep. Yes, that's where you and I differ a little bit. I'd rather make sure that I keep those shares and maybe not make a little bit more income on the covered call side. But hey, I do have one for you.
But you also have your income.
Yeah.
This
I
is
think it all just depends on what you're doing, right? Like if that's your 9 to 5 and that's what is generating you the income, then it's a completely different sort of way to do your portfolio, right? I think it's not saying you're right or I'm wrong or I'm right or you're wrong. I think it just all depends on what you're going for. But I do have a one for you as well.
Yeah, because I mean, like if you look at row 15, is it back on the thing or no?
Yeah.
That's the premium income for the year so far. And I can't survive without that income. So that's, from generating cash secure puts, cover calls, gives you everything, tells you where it all came from. This wheel tracker is just shout out to Troy Hutch. He's the angel of the channel because I was like, dude, I need something that looks like I know what I'm doing. And he was like, I happen to be a CFO and I do the wheel as well. So I gotcha. And boom, the wheel tracker was born. You know what I mean?
Right.
If y'all want access, I give it free to anybody on an email. Just send me an email. But that's what I do for a living. I don't have a 9 to 5. This is it. So I have to sell puts and calls and generate premium.
But I do have one for you, which I want you to be very careful with this one. Because it is an ETF though, but I think it might solve some of your problems of like spreading money across too many different stocks.
Okay.
And it might be a little bit more like of a macroeconomic environment. TQQQ has very good premiums.
That triple leverage on the Qs.
Yeah, and I've done it in the past, and it's gotten me to a place where I got too aggressive with it from a CSP perspective, and was writing way too high. I think, because I was just like, oh, the market's going to keep going up or whatever. But so I backed myself into a corner. So I have way too many shares on it at the moment. But if if you do that on a light basis and maybe put a small portion of the portfolio to it, I
Yeah.
think honestly, that's one. If you want something that could be kind of a moonshot, I think that that's something that could be a good moonshot. And I think it isn't relying necessarily on an individual stock, but more of
Right.
the. So I have a pretty large position in it. I wouldn't suggest most people,
Yeah, but the premiums are pretty juicy, relatively speaking.
but in a down cycle, though, the stock can drop very quickly.
Of course.
So 2020 or even in 2022 um, to now, I think the price is still 50% below where it was in 2022, but or at the peak of 2021, going through 2022 because of what happened with interest rates. So I think it declined like 70% from the peak in 2021 to the trough in 2022, and it's kind of come up on upward. So I mean, if it's one where you're looking to write, potential for cash secured puts, you could write it, pretty far down and
Yeah.
get pretty far away and generate some good premium. And it might be one where I was writing them at the money like a dumbass back in 2021, 2022.
Yeah.
But I mean, if you write far down enough where you're like, well, if there's a 20% pullback in the market, it could be one where you make a little bit of income. And if you do get assigned them, you could write covered calls and make a shit ton of money.
Of course.
Um,
So why is it triple leverage from the standpoint that it moves 3 times in comparison to the Qs, right?
on
But
a
I'm
daily
saying, like, I've always heard that triple levers are designed to only be in for a short amount of time, because there's a lot of people in as a little Discord that they created for me, and also on the chat, and they do this TSLL, and it's a triple leverage on Tesla, or a 1.5 times leverage on Tesla, and I've messed with it a little bit, but then Bill White, the friend of the channel who's on your chat right now, he was like, hey, that one might not necessarily be designed to be in long term. So it's just so like
it
how
has
does
higher
it
fees.
work?
Yeah, it has higher fees. So all these things have higher fees, and also you just have to recognize like what exactly is it trading, right? Is it trading, um, monthly contracts? Is it trading, what is exactly are they buying with it? And so the thing that's nice about TQQQ is that it's trading daily options,
Right.
right? Not necessarily something that's like a month out or something like that where you're having to pay premiums and things like that of that nature. So in that respect, it's a little bit different because like some of these ETFs, specifically when they do triple leverage, they might be buying like options contracts and more so with like futures contracts when you're talking about like triple leveraged oil or triple leveraged natural gas. It's
Right.
like those are paying premiums associated with these future contracts to which you have Katango, and Katango obviously eats the shit out of all your kind of principal, especially if the stocks is kind of staying flat. Eventually, if you look at like all um, these short or just like even normal like UNGs and stuff like that, they generally always go down into the right because they don't ever go up enough on like a month or 2 month basis where they're able to kind of like pay for all the fees that are kind of going into it. But TQQ is a little bit different, and that's I don't know. Do some investigating. I wouldn't say like pull a port like put the whole portfolio or anything to it. I would just do like a little bit of a look into it of like the returns over the past since it's been online and since 2010. It's returned 6,500% or something like that. So in
Wow.
that respect, it's pretty enticing. So obviously we've been on a really good bull run from 2010 till now, right?
Right.
So
Yeah.
that kind of makes sense for it. But my thought process is even if we do half or a third of as good as what we've done in the past say 13 years compared to what we did the last 13 years, then it'll still return potentially uh 10x or 20x potentially. And so my thought process is you could write covered calls on that in the meantime, wheel it, see how you do. And there was a guy that I used to talked to, he was big into the wheel strategy. He would do it a lot on SOXL. That didn't turn out so well because SOXL is semiconductors only, and a lot of
Right.
those took a pretty big hit in 2021, 2022. But TQQQ, I think, is a little bit more balanced overall for technology. But I have like 1,400, 1,500 shares of it, and I just write pretty far out of the money covered calls on it, and it generates pretty good income. But for somebody like yourself, it could generate really wild income, a couple percentage
Yeah,
a month.
I've seen it in your portfolio because occasionally you'll show your holdings, and I've screenshotted your shit because I'm
Yeah,
always, dude. I always, when someone shows their portfolio, I feel like, okay, this is a chance where I can cheat at investing. So let me like invest with Henry. Let me give a shout out to invest with Henry. Did I screenshot his shit all the time? And I get ideas. You know what I mean? I get ideas. There's a guy, Will Snowball. He shows his portfolio. He's got a couple $1,000,000. So I'll screenshot his as well. And you get ideas of stuff that might not have been on my radar. And that's when I saw TQQQ. One that I also do that I'm not done on the channel, but I have it in the portfolio now. And I've been wheeling it successfully going on the third year now is Kathy Wood's flagship ETF ARKK, because it has a lot of holdings that I want to be part of, but I don't necessarily want to be part of them individually.
right.
And the premiums are pretty decent. I average about 0.5% per week on a freaking ETF, and it gives me my Tesla exposure, my, this other shit that I'm interested in, but not interested enough to want to just wheel it individually because it's a lot more work. Like when people give me stocks, I'm not real quick to jump on them, Matt, because I know the work that goes into learning about these companies. I got to go listen to 3, 4, 5 earnings calls to get familiar. And I'm like, dude, it's like, I don't want to invest 20, 30, 40 hours. I'm lazy, so
Right.
I try to stick with the ones that I got. But I got to get rocking and rolling, man, because I got the lady that's going to be here at 6 a.m. to do wound care and give me the IV,
Oh man,
and we're just trying to get healthy again, man. But I appreciate you inviting me back, and
absolutely.
definitely I'd like to have a more detailed discussion on how you did your napkin math, man, because it's real impressive to me when I see people do it, and you're like sitting there spitting out, whoa, if Palantir does this, it's going to be trading at this multiple. And I'm like, dude, I got to go. I don't know how to get that information without looking at my balance sheet and cash flow statements and all that
Well, I
stuff.
normally do, right? And a lot of it's from memory. So um, I normally can't make stuff up on the fly like that. I normally have to have a view of what the balance sheet and cash flow statement kind of looks like. But yeah, in time, and maybe it got a little crazy. We had Steven on, which I'm glad he did. It's not a say that it wasn't, but it looked like we want to talk about NVIDIA. Chris and I wanted to talk about a bond we might buy together, and it just seemed like there's just a lot of topics. So
Yeah,
yeah, if you're around later this week or early next, or even next week, I think we're going. Earnings season's over, so we might have a lot more
it's
free
exciting now.
free conversations. So
It's 3 to 4 times of the year that are tough for me, and that's earnings season. That's
yeah,
it. I
there you go.
find myself looking, when's the next long weekend? And this one was the one that came up on the calendar, and I didn't realize I was going to have a real long week at the hospital. So now I'm like ready to get back to work. But
Yeah,
yeah,
cool.
appreciate all of you guys, and I'm just here to learn. I know that yeah, I got a big portfolio and I make a lot of money, but I'm learning just like the next guy, man. Like there's a lot to learn out there, guys, and
Absolutely.
it's
All
a
right, my
never
friend.
ending. It's a never ending thing, unfortunately.
Yeah,
So
I'm always learning. If I'm not learning, I'm not having fun. So much
yeah.
appreciated, man. We'll have you on next time.
Appreciate you, man. You have yourself a good one, but
You too, brother. Happy holidays.
take